If we can ask you all to take your seats, we will get started on this morning's program. So good morning and welcome to the September 2023 UCLA Anderson Forecast conference, where we are partnering with Impacted Anderson. So we're going to roll out the forecast first, and then we have an amazing keynote and panel, and they're going to be discussing climate change and California, climate change and the economy. And so that is coming up. A couple of announcements first. At 11:20, we are going to get on our cell phones an emergency alert. I don't know how we can intercept it and silence it, but let's try. So in the time of the break, please put your phone on airplane mode. Might not work, might still go through, but let's see if we can avoid having everyone's phone go off at 11:20. So again, we want to thank UCLA's Impacted Anderson for partnering with us on today's conference. We usually have a little bit of time for questions. We may not have much, if any, today. We're starting a little bit late and we have a full program. But for those of you who are here in our audience or on the enhanced virtual, please have your questions, submit your questions. You have a Slido code, which is on the handout, and put them in there. We certainly won't get to all of your questions, but what the economists of the forecast will do is look at your questions, provide answers, and send emails to you with the answers to all the questions. So we do want to answer your questions, but time is limited. And so we have our forecast team here sitting in the front row. Just like in our classes here at UCLA, everyone starts sitting in the back and moving to the front. So the forecast team got front row seats. We have 3 new economists on our crack forecast team, and you're going to hear their research in turn as we go forward through the year. We have Thomas Ash, who comes to us from USC, and he is an environmental economist and is working environment and the regional economies of California. And we have Sayantani, who comes to us from our sister institution, UC Irvine, who is a real estate economist and is joint with the Ziman Center for Real Estate here. And Ji-Yoon Lee, who's going to be talking today, she is a climate change economist, and she'll be talking about some of her research, which she's just started on California and wildfires and the economic impact. And then 2 folks that I think you know, William Yu, who has been with us 11 years, came to us from University of Washington, and then a stint teaching in Minnesota. And of course, our distinguished emeritus professor, Ed Leamer. And Ed has been at UCLA since its founding, right? and we're going to lead off today's program with Ed talking about recessions, inflation, what we know from the data, and what humbly the data doesn't tell us. And then I will follow with the US and California forecast, and then Ji-Yoon is going to talk about her research on wildfires in California. We'll then take a break, have the keynote and our panel. So before we get going, and I turn this over to Ed, I do want to thank our sponsors. We're a public institution, and we couldn't put these programs on without our sponsors, so we are most appreciative to them. Our principal sponsor today is RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International and Pacific Western Bank, Robert Half, United Airlines, and Venture Forward by GoDaddy. At the silver level, Bank of California, Commercial Wealth Management, Scott Work North America, U.S. Private Bank Wealth Management. At the bronze level, Hominy Bank, HDR. Bruin level, Gerber Kawasaki Wealth and Investment Management, and SoCal Gas, and our academic sponsor, UCLA Extension. And I'd also like to express our thanks to three people, George Lee, Seth Katz, and Virginia Cruz-Godow. They are our staff. They make all of this happen. We just provide the content, but it wouldn't happen without them. We're most appreciative of them. And so with that, let's turn to our program. And I'd like to turn it over to Ed Leamer to talk about what we know and don't know about inflation and recession.
Mostly what we don't know. So I'm going to talk about three scenarios that have to do with inflation and interest rates. The first scenario is that the inflation, which is now about 3.3%, drops dramatically to 2%, and the Fed celebrates by reducing their interest rates. So I'm going to show you the evidence, the historical evidence, which says that you don't get a drop of inflation without having a recession, having a spike up in unemployment. So that leaves the other two scenarios as the choices. One is the Fed says 3.3, it's okay, it's persistent, we can't get rid of it, but let's treat that as a new normal, and they lower the interest rates, that they lower the short-term rates. But the other possibility is the Fed says we are going to reduce the rate of inflation, and we're going to spike up interest rates until it happens. And then you get a recession, a real recession that causes a reduction of inflation. So I want to give you the evidence that's the basis for my opinion. So first I want to tell you that the economists traditionally, I'm not in control here. Traditionally, no economist ever predicted a recession. This time, every economist is predicting a recession. So if you believed in the validity of economist thinking, you just have to flip them around to get the right answer. So this time, there's not going to be a recession. But I'm worried about this. I'm not in too much control. The question is whether, are we having a soft landing? Whatever metaphor that means, and or are we going to have a recession soon? I worry about that. That's a scenario. So this is really not what. First question is, what's a recession? Judge Stewart, this is really delayed, super delayed. Judge Potter Stewart, talking about a pornography case, said, I don't know what it is, I can't define it, but I know it when I see it. That's exactly what the economists do when the economists who control the National Bureau of Economic Research. This is not working. Anyway, they have this vague definition. They meet together and they hold up pictures and they say, is this pornographic? And yes, that's it. And that determines whether there's a recession or not. My own view is that a recession is a period of unwanted idleness. Which way do I go? Here it comes. So it's unwanted idleness, idleness of labor in particular, which means elevated unemployment rates, or idleness of all other kinds of capital, like lower capacity utilization in manufacturing, vacancies in apartments and offices. So here's the unemployment rate. It's the mountains of unemployment. Can you see that? I want you in your mind to color code the side of the mountains that's facing to the left. Make it yellow. That's exactly what the NBR does when they define a recession. That yellow is the NBR official recession. So you can see it's always elevated unemployment. And I'm going to talk about what the recessions mean about inflation now. And we don't like inflation, obviously. What's bad about unexpected inflation? This is going so slow, I'm not going to get through it. Inflation unwinds the bonds contract. You get to pay back your loan with cheaper dollars. But inflation is a problem that prevents people from shopping. Like I do with Amazon Prime. I just go to Amazon and buy everything on that. So I'm not aware of the better options elsewhere. And that creates an inflationary environment because firms can raise prices without any risk of lowering or losing those customers. This is bad. There's a demand side story and a supply side story for inflation. I don't want to get into this. I have hardly any time to talk. Is it going to work now? Where do I point this? Well, I'm not and I need to go through these things quickly. I'm trying to talk about how inflation is a self-fulfilling social disease, primarily, and that the Fed has to eliminate our beliefs that inflation will occur. So if you're running a restaurant and it's competing with my restaurant in an inflationary environment, you can raise prices without losing your customers because the customers are thinking you're doing something normal. So you create kind of a monopolistic approach in the restaurant business as a consequence of that inflation, and it takes unemployment to get rid of that. So what?
Just say next and we'll.
Next. I don't have any time. Next. So there's the question is whether we're going to have a soft landing, meaning a cure for inflation without having a spike up in unemployment. I want to make sure it includes the notion of a cure for inflation, not just that the Fed backs off and before the recession occurs. So here, next. So this is the image that I'd like to leave behind you. This has the image that captures the evidence about the relationship between recessions and inflation. And the blue bars up and down represent those periods of recessions when the unemployment is spiking up. So hit it again. That is the consumer price index. The vertical scale is logarithmic. The reason you use a logarithmic scale is because a constant rate of inflation in a normal scale has that kind of curvature, but you create a log scale, then it's a straight line. You can see the straight lines in this picture extremely well, I believe. So let's see, we have, for example, that back in the 60s, the rate was about 1.2%. Hit again. Then in the 70s, preceding the Volcker period, it spikes up to 8.6%, again, 2.5%. And then post-COVID, it was at 8.4%. And then it dramatically falls to 3.3. That's where we are now. And there's a long-term persistence to these rates of inflation. Next, that's the Volcker era in 1979. Let's look at some of these recessions. Can you see that in that recession, the inflation was higher and then the recession brought it down? You can see that or no? Hit the next button. That's 3 or 4 more. You can see each one of these, the inflation was high and it was being brought down. Keep going. It takes a recession to bring down the inflation rate, except for the one up in the right. And that's the one that we're in now. But there's also one over here on the left, 1951, in which there was a spike up of inflation and it got brought down. Why was that? Next. That's because there was the Korean War and the Department of Defense increased spending dramatically from 8% of GDP up to 16% of GDP. Yeah, it's huge. So that created that inflationary environment. Next picture. But then inflation drops off. Why? Because they put price controls in. They had laws that said you couldn't raise prices anymore. So that's a very distinctive image. And everything else is saying, yes, we had supply chain interruptions. We had concentration of sales on the goods side, not the service side, because face-to-face was something we were trying to avoid in the COVID era. That makes it inflationary. We had the federal government giving us huge amounts of money. That was all being spent. That created inflation. That seems like it's behind us now. And the question is whether we're in a 3.3% world going forward. So let's go next. So what I'm saying is it takes a crash landing in order to slow inflation. That's what the history tells us. I don't know if the Fed completely realizes that, but because they have this idea of softening the economy and a soft landing. And then next, I already talked about how the COVID circumstance gave to more inflation. Keep going. And this is Jerome Powell saying he knows what he's doing. And I say, really? And moving on, I don't have much time to do all this stuff. Moving on, I want to get to the next image. Now, having raised this point, the question is there evidence that a recession is going to occur? And I think we got to look to Wall Street and look to Main Street to find that evidence. The Wall Street evidence is through the bond market, what's called an inverted yield curve, where the 10-year Treasury is paying less than the 3-month Treasury. But the two main drivers of early signals of a recession on Main Street are houses and manufacturing jobs, construction jobs and manufacturing jobs. So this is a yield curve. We're going to take a look at it. The horizontal axis tells you the length of the bond, or a 6-month, 2-year, 5-year, 10-year, 30-year. The vertical axis is the rate of interest on those bonds, and you can hit the button again. So that's an inverted yield curve where the 3-month is paying about 6%, and the 10-year is paying about 4%. Typically, it's upward sloping. That was like a year ago, it was upward sloping. Now it's flattened out a little bit because the 10-month yield is getting higher. So the bond market, which uses an inverted yield curve to say a recession is coming, the bond market is saying, I don't think so much anymore, because the 10-year rate is going up, and that flattens out. Okay, next picture. So this is the 10-year rate minus the 3-month rate, and hit it again. You can see the inverted yield curve at the far right, and then I circled another one and another one, and after those inverted yield curve came the recessions. Well, there's one that we got 1970, and that's the one that occurred in the midst of or immediately preceding the Vietnam War, warning that a recession was coming. But again, the Department of Defense spiked up spending dramatically because of the Vietnam War and offset the bond market's prediction of a recession to come. So this is pretty clear. Now, next picture. Next, keep hitting this. So what this picture shows you is an illustration of the evidence that an inverted yield curve indicates that a recession is close. And the horizontal axis is the 36 months before the recession. Each one of those lines represents a different 36-month period ending with a recession. So the recession is 1 month beyond the end here. And what you can see, hit again, you can see that's the average of the slope of the yield curve. And hit it again, it's going to go, it's going down, obviously. So if you have this historical, if you have current data that suggests that we have an inverted yield curve, it's telling you that recession is within a year to come. Hit it again. So that's the data. Those little triangles represent the data that we have now. I don't see the timer either. Oh, it's right there. Okay. Oh, 1:44. Oh, God. Okay, next. Next. And I'm going to tell you that housing and manufacturing are early warning signs of recession. Next. This is housing starts. You can see housing starts are declining going into the recession, before the recession. Next. This is the declining housing starts. I want to get to weekly hours of manufacturing. This is the reason the history is different this time, particularly in the housing sector. So this image is designed to show you the overbuilding and the underbuilding of housing. So the average rate was 1.43 million per year. So if you want to have the same amount of housing, at a flat rate, it would be 1.43 million. This is a picture that shows you when it's above 1.43 million and when it's below, building at a higher rate or lower rate. So you can see there's a big overbuilding followed by underbuilding and recession, another overbuilding, followed by underbuilding, another overbuilding, followed by underbuilding, another overbuilding, followed by underbuilding. We've never had that kind of underbuilding. That picture is enormously different this time. So there's no overbuilding that's going to create a big problem in recessions. So then let's look at the manufacturing too, and then we'll stop. My view that was an important point, which is low interest rates are the equivalent of opioids because we love it. Give us low interest rates when we buy a house, but then a few years later things don't turn out so good. So the Fed is giving us those low interest rates, and you can see I had those Purdue Pharma CEOs on the right-hand side of that picture. Anyway, there they are. Keep on going. This is weekly hours in manufacturing. Hit again. You can see they're going up and then going down before the recession. So hit again. That's weekly hours in manufacturing. I want to tell you why manufacturing doesn't matter anymore. These are those slides that represent, on the left-hand side, that's durable, a fraction of durable manufacturing relative to overall payrolls. On the right is the non-durable, so hit the buttons and get the lines. We're down to almost no jobs left. We're in a post-industrial world. We killed off our democracy by giving away our jobs to China, to tell you the truth. But the recession going forward is not going to look like the ones historically because it doesn't have the housing problem, and it has such a small manufacturing sector that we're not going to get the terrible downturn that's happened historically. So I think there's a fourth scenario, which I've just supported, which is the Fed is going to say, oh my God, we've got to get inflation down. So we're going to jack up interest rates pretty high. And they still can't get it down because they can't create a recession anymore. That's my story. I'm sorry I didn't have more time to. Oh yeah, so this is the message that I was just capturing, is that in order to forecast the future, we look backward to the historical data. I gave you images of historical data. And it's like driving a car in which you're not allowed to look forward. You can only look in the rearview mirror to decide where you're going to go drive the car. And the problem is that's good if the past is a good symptom of the future. And it's not anymore. We're in a post-industrial society, and we have hardly any jobs in manufacturing. And this is my last event. You can do this quickly. Go ahead. I want to leave behind what I think was the four big problems that we need to deal with collectively as a country. First of all, climate change. Mother Earth is getting tired of us and wants us to go away. And Thomas Malthus says we're going to have too many children and they're going to drive down the per capita income. We're having a transition to a post-industrial world in which talent is the critical factor. The 10% of people will be able to have jobs. The rest will have to stay at home and run the equipment, I guess. And then this debt situation is totally out of control. The student debt. All the children of America have huge burdens on them because they're the ones who are going to have to pay the debt in the future. And our political system is completely ignoring that huge burden that we're building up for the kids. And now I think we're having growing failure of American education. K-12 is particularly troubled. And I also think colleges and universities are troubled too, with extremely high tuition, where we're taking most of the value of the education and putting it in the wallets of the faculty and administrators. And then we put too much focus on research and not enough on education. Adios.
And one of the things that we are pivoting to in teaching our students is my new remote mouse, and let's see how this works. George, can you bring up my slides? Reports coming out throughout, unexpected because, as Ed pointed out, most economists, not us at the forecast, most economists has been predicting a recession next quarter, and every quarter a recession, and the next quarter a recession, and it hasn't happened. So this robust economy has for most been unexpected. What we did 3 quarters ago, I guess 4 quarters ago, because we did this for 3 quarters, at the forecast, as we said, the Federal Reserve, represented here by the Board of Governors building, has increased interest rates rapidly. And if we look at this historically, that results in something happening to the economy in interest-sensitive sectors declining, demand declining, somewhere between 6 and 12 months out into the future. Now we're 18 months. Right. And we haven't seen that. We have the robust economy. But while we are still uncertain about this, what we were doing was presenting you with 2 scenarios. One, a recession scenario, the other, a no recession scenario, saying if a recession happens, here is our best forecast. Now that we're that far into the future, we just have one scenario, one forecast. But the best current evidence, as represented in an NBER paper by the Romers, is that there will be some residual effect 24 months. That's 2024. And so we do have that built into our forecast. Now, let me show you this picture before we get to the forecast, which is what do these two have in common? You just heard an announcement of a retirement. The guy on the left also announced a retirement. Neither of them are credible. You haven't seen the last of Professor Lemur telling us about his research at forecast events. Okay, so now let's move to what we're going to talk about today. First is the macroeconomy. So GDP, inflation, interest rates, and then we want to look at interest-sensitive sectors and other sectors that are kind of behind the forecast that we have today. And then we'll turn to the California forecast. So let's just jump right in with the macro forecast. And the chart that you see here is GDP growth rates. To the left of that vertical line are the actuals, and the actuals go through the second quarter of this year. And we have 2.1% is the actual for the second quarter. We have 2.7% for the current quarter. And then it declines, and it declines almost to 0 in 2014. So 2024. So 2024 is a 1% economy. And this is the residual effect of all of those increases in interest rates that we're just starting to see, but it doesn't go negative. It's just that the growth rate of these interest-sensitive sectors, which I'm going to show you momentarily, slows down, and that slowing of the growth rate slows GDP growth rates. And then we go in 2025, growing back to trend by the end of 2025. Another way to look at this is through the levels. The blue here are the actuals. The reds are forecast. That black dashed line is the 2.4% GDP growth trend from 2018 and 2019. And if you look at this, you say, well, the economy's got a lot of slack in it, right? But the unemployment rate is actually very low. So how do we have all of this excess demand that's supposedly causing inflation? The reason is that that in this period of time that we call the Great Resignation, boomers dropped out of the labor force and retired in droves by the millions, and they're not coming back. So even though the labor force participation rate is up for prime working age adults aged 25 to 55. That's a smaller cohort, and it doesn't quite make up for all the boomers who have retired. And so good job markets have brought people in, higher wages have brought people in, but it still doesn't quite make up for that. And we just do a 1%, little less than 1% reduction in that dashed line to represent the reduction in the total labor force. Because if you have less people, you just produce less and less productivity goes up. You get that we are right on top of the trend, but the slowing economy in 2024 is going to take us below trend. And even when we get back to trend growth rate, we're not back to that dashed line. And the unemployment rate is now 3.8%. And so a low unemployment rate in the job openings and layoffs report that just came out. Job openings went up. So they went up to 9.6 million, and layoffs stayed right where they are. And if you look at the layoff rate, it is historically low. So still very good job markets, very tight job markets. So that brings us to inflation. The top line here is headline inflation. The bottom line is core, that takes out the volatile in terms of the way prices move, food and energy. And you can see that the headline and the core, they kind of peak and then they come down. And the arrows there are pointing to the latest month. The numbers that you see, the lines there, are quarterly, but the arrows are pointing to the latest ones. And what you see here is a 4.3 and 3.7, 4.3 for core. And it kind of, it stays high. It's not coming down that fast. 3.3 is, it's 3.7 is the year over year for headline. Ed quoted a number of 3.3. That's the run rate right now. So it's actually running at less than the year over the year. But what you hear on the radio and in pronouncements by the Fed are the year over year numbers. That's why we show them. We have that coming down. But because we don't have that big recession that Ed was talking about that would drive inflation rates down to 2% or less, it kind of flattens out. And we end up at the end of our forecast period with, we're just hovering around 3%. We had 2.8% for headline. Okay, and so our assumption is that the Fed is going to be good with that because they understand what's driving those numbers. And so this is a little bit complicated graph, but it tells us what's driving the numbers and what the Fed is looking at. This is the cumulative, the orange plus the blue are the cumulative inflation rates. And the way in which the inflation metric is constructed is a survey is done of households and what households purchase. And each item in that basket is assigned a weight, and the weight is the percentage of the average US household's expenditure on that item. So for example, way over on the left is alcohol. We know alcohol prices have gone up a lot, but for the average American household, not every American household, but the average American household, alcohol is a really small percentage of their budget. And so it's given a small weight. And the buildup to the numbers that I just showed you in inflation really are dependent on the last two there. The last one is shelter, and shelter is just rents. So it's not mortgages, it's not your cost of housing. If you own a home and you have a mortgage, it's just what people who rent their home are paying. And that's given a weight of 33%, 1/3. And that's huge, but what rents are comprised of are the average rents that people are paying. And rents are paid according to leases, and leases are long-term leases. So it takes a long time for that to get out of the system. Even though rents aren't really going up very much now, it's going to be to our forecast horizon to really get that out of the system. The next one is other transportation, and it's not the airplane tickets that we bought. It is automobile repair and the insurance to pay for that. And the reason is that the cars that we're driving today are radically different than the cars that we drove even 5 years ago in terms of the cost of repairing. Electric cars are much more costly to repair, and cars that have driver assist, which most new cars have, are more costly to repair. And just an example of that, If you replaced a windshield on your car because a rock hit it or whatever, say 10 years ago, a guy came to the house, popped the windshield, put the new one in, sealed it, $300, $350. Today, if that rock hits your windshield, you have to take it to a specialist. They'll pop the windshield out, they'll put it in, they'll put the sensors back in, they'll calibrate the sensors, $1,500 to $2,700, because it's a much more specialized task. And that goes all the way through the repair of automobiles. So interest rates don't affect that. It's just the difference between an iPhone 5 and an iPhone 15. Very different products. The third one there, which is actually negative, is healthcare services, and that includes health insurance. That is actually going to impact inflation and keep inflation a little bit higher as healthcare insurance premiums are going up. Wrong direction. So what do we have for interest rates? We have the Fed increasing the Fed funds rate by 25 basis points. We put it in November, it might be in December. It's a way of signaling that they're still serious about inflation. But as you get into, and then they hold it at that high level, even in the face of a weakening economy. But as you get to that third quarter where economic growth was almost zero in that first picture, we have the Fed saying, well, we're concerned about that, bringing it down 25 basis points, sort of ending that one that happened in November of this year. And then a couple more, so very small decreases, but then the economy gets going and the Fed funds rate stays high. And then you notice the other three lines there are the 10-year, the 2-year, and the 3-year. That's where the yield curve inversion has been. And we have it going right side up as investors realize that, in fact, the Fed's not going to dramatically lower interest rates. They're going to stay higher for longer. And we get a more normal yield curve. So that brings us to what's leading to this forecast in the interest-sensitive sectors. You see Jerome Powell there in front of the Fed building. First thing we want to do is look at housing. Ed talked about housing and the importance of it. Ed also wrote a paper called Housing is the Business Cycle, because of the importance of housing in almost every recession that we've seen post-World War II. There are a couple of them that were cutbacks in defense. There was one that was overbuilding of computers and software, but the rest had big declines in housing. If we look at building permits, what you see here, 2018, 2019, you see everything stop in the lockdown of 2020. And then we have this surge that I call the pandemic surge of building. There's a lot of migration going on. As we all know, when we started working from home, people wanted bigger homes. They moved to other parts of the country. And so we got a surge of building for these new migrants. That's over with, and we're back to where we were before. But I think what is significant here, vis-a-vis whether or not we get a recession, is that back in 2018, 2019, the average 30-year fixed mortgage rate was 4.1%. And the number of new permits was between 1.3 million and 1.4 million. 1.4 million is about the historical average. Today, maybe not today, but over this period of time, because they've just gone up, we've got higher 30-year fixed mortgage rates, and that's at 7.3%, an average over that period. But we're up at 1.5 million, just under 1.5 million units. So it's going the wrong direction. It's going up. In fact, the latest numbers for August, 1.54 million on an annual run rate. So increased interest rates may have cooled the housing market from what it would have been, but it hasn't tanked the housing market. And so we're getting no pressure there from higher interest rates cooling housing. If you look at kind of year over year, and we're going to see that when we get to California, you get negatives because of that pandemic surge. But that pandemic surge was a temporary thing. And if you go from normal times to normal times, we've got an increase in housing. Light vehicle sales, we also aren't overbuilt in light vehicle sales. The big dip there is in 2008, and we just barely recover. We don't make up for it. We just barely recover to normal. Then we get the downturn. Then we get the chip shortage, and we've got to the right of that line between actuals and forecasts, we've got a dip because of the UAW strike. But we think the UAW strike is going to be fairly short because there are a lot of competitors of the big three who want market share. And they're going to ramp up production, and the big three really are concerned about losing market share, particularly to EVs. And so interest rates are not really affecting that, principally because automobiles wear out. If you have teenagers, automobiles wear out faster, and you have to replace them. And we haven't been replacing them. So look for autos to hold up. What about durable goods manufacturing? Ed showed you that in terms of employment, that's not as important as before, but maybe it's a little bit important, except for this is durable goods manufacturing. These are new orders for durable goods. And it's X transportation because we've taken Boeing out basically. But, and it jumps around depending on what month Boeing makes a sale. But new orders are up at record levels, but the growth rate has slowed down. That's that slowing of growth that we have in 2024. We have that extrapolated out. And what about manufacturing? Well, we've shifted to industrial policy with the CHIPS Act, with the so-called Inflation Reduction Act that had nothing to do with inflation. And we are building more factories now than we have in a long time. And that's all over the country, including in California. And so factory construction is up. The census just released this morning the August numbers for construction, residential construction in value up, non-residential construction up, and public construction up. So interest rates may be affecting this and slowing it down, but it's not turning it negative. So now I want to look at some other sectors, and I want to look at consumption, defense, and of course, we've all heard about all the big layoffs in tech. So this is consumption, and it's real consumption, and we have taken out, so real consumption takes out inflation, and it's above trend and going up. The latest retail sales numbers, so that's for goods plus restaurants and taverns, were up, and not just up because of inflation. They were up in real terms. So we're spending, and that's a change in preferences that really the pandemic has given us. We want to be out spending. We want to be out with other people. We want to be doing things. That's really different from before. There is concern about whether there's this excess savings, there's excess debt. It doesn't seem to be impacting that. And for most Americans, that so-called excess savings is gone, and we're still spending. So let's look at defense. Defense expenditures are up in the current budget year, and it's hard to imagine in this more dangerous world that either the Democrats or the Republicans are going to go for a defense bill that will reduce spending. Of course, you have to have a House of Representatives that actually can vote on something, but presumably that will happen. And so defense is going to hold up, and that's going to be defense durable goods, right? And so that adds demand to the economy. And then tech. So this is nationwide, 2 sectors that are heavy in tech. The top one is scientific and technical services, professional scientific and technical services. The bottom one is information, and this is output. Output's growing, right? And when we get to California, I'm going to show you employment in these sectors. So tech is not imploding. It is not 2001 all over again. And so summary for the US, the economy is strong. We have headwinds that the Fed is trying to cool the economy, but we have an unusual circumstance where the Fed is engaged in contractionary monetary policy, and the executive branch is engaged in expansionary fiscal policy. And given that we didn't overbuild in these sectors that normally take us into a recession, that countervailing force of expansionary fiscal policy is enough to keep us out of a recession. So what about a recession? There is one coming eventually, because it always does, but not in the near term. Okay, so we need to talk a little bit about risk to the forecast, especially because in a 1% economy, even fairly small but significant shocks can flip you over to negative. but those are going to be unexpected. So we have Russia, Ukraine, of course. Where are we going here? China and Taiwan. But this one, I think, is maybe more significant. As we move into 2024 and the election, if it looks like either Congress or the presidency is maybe 50-50, that you're not sure which way this is going to go, the Republicans and Democrats have radically different economic policies. And so that creates uncertainty for business, and that could drive business investment down. And that's 2024 when we had a 1% economy. So I think that's a big risk. And then, of course, climate change and migration, which we're already seeing at our southern border. But more importantly, in the supply chain in Asia, this could be a real problem, depending on what happens with the world's climate through our forecast horizon. So now let's look at California. And the way in which we do our forecast is we say we've got a US forecast. Now let's take a look at California. California is part of the US, forecast should be the same, except for in some ways that the California is different. So we ask ourselves, how is California different from the US? And one thing is we lean to the left. But we want to look at the economic, I love this picture of San Francisco. Just looking at GDP, these are taken from the 21 largest states in the US. Those are the ones that actually move GDP. So the other 29 are small, they're 1% or less of GDP. Delaware is an important state, but if Delaware grows by 10%, which would be outstanding, you won't see it in the aggregate numbers. So these are the important ones in that sense. US on the right-hand side, California's in gold there, of course, and the usual suspects of Florida and Texas and the like are there also growing faster than the US. But there are two ways you can get GDP to grow. One is have more people. This is why China has the second largest economy in the world, but is a very poor country. They have 1.4 billion people doing stuff. And so there was a lot of migration. We saw that in the housing numbers, a lot of migration over the last couple of years. Some states gained a lot of people. We lost here in California about 500,000 people. So let's look at the other way you can get an increase in GDP, and that is through increased productivity. And if we adjust for increased productivity by looking only at per capita GDP growth rather than aggregate GDP growth, we find California is all the way over in the left. Florida still stays up there, and most of the usual suspects stay up there. The migration into Texas was quite large, and Texas kind of falls off this graph. So California is still doing very well, but let's take a look at what is happening in terms of employment. That's the best data we have on the state, 16% decline in the Great Recession. We are now above where we were in 2019, the previous peak. We're at 2.5%. That's why traffic on the 405 looks like pre-pandemic. More people are working in payroll jobs. This doesn't include farm jobs. I'm going to show you that in a minute. But so we have an increase in employment in California and increased productivity. This is by sector, and you see there's only one, and this is from pre-pandemic. There's only one sector that's really kind of lagging there, all the way over on the right-hand side. That's wholesale trade. That's about 3.6% of California's total employment. But the sectors that are growing, that are significant here, are durable goods manufacturing, construction, technology, and logistics, more than make up for any of the losses that you see there. And then the ones that are not, that don't have arrows, are home healthcare principally, temps, and the third one is leisure and hospitality. So those, the low income sectors have recovered now finally. If we look at it regionally, and there's the US in the light color, most parts of California are growing faster than the US. We have 4 that are growing slower, and there's San Diego, Inland Empire, and Silicon Valley. This is year to date. And then the fourth one is the San Joaquin Valley, and this includes farm labor. And that's because of the weather events and its impact on agriculture a big industry in California. It doesn't employ a lot of people, but it's an important industry in California. And so that's an industry that so far this year has actually declined. So let's look at some sectors. One is tourism. The upper left-hand side is passenger arrivals at LAX and SFO. And international tourists are really important for California. So you'd think that, we're recovering here. That's not what this is. This is us going to Italy and Japan and coming back home. Chinese tourists, who made up 1.8 million tourists in California in 2018, 1.8 million, have not come back. They had zero COVID. Now there are issues about getting visas. That's starting to get worked out. There are also issues about the number of flights between the US and China. But importantly, as the economy softens in 2024, we expect some offsetting from Chinese tourists coming back this week, which is a holiday week. Chinese families are starting to travel again. So we're expecting at least some of that to be mitigating relative to the rest of the US, because Chinese tourists go to Los Angeles, San Francisco, Las Vegas, and New York, and not elsewhere. The other thing that's telling here is on the right-hand side are passenger arrivals in wine country at Charles M. Schulz Airport in Santa Rosa. And the middle lines, two of those middle lines are pre-pandemic. And then the green line at the bottom is during the pandemic, basically goes to zero, kind of comes back the next year to normal. And the top two lines are this year and last year. Record domestic tourism happening. Okay? And so we have changed preferences in terms of tourism. We want to get out, we want to travel, we want to do things. 15 months was a long time to be locked down. Turning to manufacturing, and here's why we see that burst in productivity. One of the reasons why we see the burst in productivity in California, this is the change in employment year over year through the latest data that we have on manufacturing by type of manufacturing. On the right-hand side, what you see here, the growth is transportation equipment. So that's airplanes and cars, sophisticated equipment, computers and peripherals, and machinery. On the left-hand side, you get things like wood products and furniture. We're getting a transformation to advanced manufacturing in California, sophisticated manufacturing. And a bunch of that is going into defense and space, which certainly affects us here in Southern California, and that's not interest sensitive. And this, I don't know if you can read this, but this is where the defense dollars go. And you get down to about 7 states, and you get almost all the defense dollars. 2 of those states, Maryland and Virginia, are because the corporate headquarters of companies like Lockheed Martin are there. And so that's where it's booked. But Texas, California, Connecticut, they get kind of the bulk, and Georgia get the bulk of the defense durable goods. So again, disproportionately favoring California in a weak economy. Now let's turn to tech employment. This is professional, scientific, and technical services in California. Squint as you might, you can't find those big layoffs. What's happened is the layoffs occurred, to be sure, but there are a lot of companies that are hiring. And there was an article, NPR in Seattle, about the Amazon layoffs in Seattle. And that the tech companies in Seattle were really happy about that because they didn't have to compete with Amazon and could finally staff up. And all of those people were being rehired. And that seems to be happening. And one of the things that's really happening here is AI, and money is coming into California to support AI research and development. And that is centered in the Bay Area. The other thing that I think is important is Silicon Valley Bank, which is a part of the ecosystem in Silicon Valley. And we know that that went under, but it's still operating. Its international operations, Shanghai is shut down, but Silicon Valley Bank is still open with the same management in the Valley, not with the same resources, but they're still part of the ecosystem. Now moving to housing, we have a decline in home prices from the peak. from that pandemic peak, but home prices are now above 2021. This is the median price, which is subject to compositions of high-end homes aren't selling. The median is going to be coming down. But the Case-Shiller Home Price Index, which is for San Diego, Los Angeles, and San Francisco, all showing home price increases. That induces builders to keep building. If we compare to the pandemic surge on new permits, the left-hand side is 2021 to 2022, where across the country we saw lots of declines in permits. California's in the blue there, and it's negative, but just barely negative. The right-hand side is year-to-date by kind of major regions. And the fourth one over, so the largest decline is the West, excluding California. So these are in the 15 to 25% decline. California's 7.6% decline. So again, when it comes to housing, and part of this is because of the 7 bills passed by the state legislature, making it easier to build as the state legislature has the state superseding local zoning in permitting building, and the fact that we're really underbuilt in homes in California. So again, when it comes to home construction, California is going to do better, relatively speaking, to the US. So what makes the California forecast different? Leisure and hospitality, we have the potential for the international tourists. Manufacturing, high-tech, defense, and aerospace are all increasing in California and disproportionate in California. Tech is the new darling of the VCs. Construction, we have these new housing laws. We also have factories going up, and we have warehouses going up and some retail. So we're seeing increased construction, and then just some numbers to finish us off. A weak economy in 2024, not quite as weak as the US, but a weak economy. And then we are going to start growing as we move into 2025, but the unemployment rate on a quarterly basis is going to go up to 5%, and then it's going to slowly come down. Higher than the US, but California always has higher unemployment rate than the US. So that brings me to the end, and you look at this picture and you think about Houston in July. And I'll leave it at that because that's going to bring us to our next talk. Oh, and our next talk. So let me introduce Ji-Yoon Lee, who came to us from Cornell and is studying wildfires, and she's going to give you an introduction to some of the work that she is doing on wildfires and their economic impact in California. Thank you. Yeah, just press the down arrow.
Not working.
George, can you bring the keyboard up?
Oh, it's working now. Okay. Okay, sorry about that. Hello, everyone. I'm Ji-Yoon Lee. I'm an economist here at UCLA Anderson Forecast. So today I'm going to present a portion of my ongoing research looking at impact of wildfire on the economy and how we adapt to the wildfire risk. So today's presentation, I'll focus on the California economy, which has a long history of wildfires. Okay. Oh, it's not working again. Yeah.
Sorry.
It's okay. Yeah. So as you know, climate change is a real and ever-growing threat to our society, especially for Californians. Climate change makes conditions more favorable for wildfires. For example, rising temperature, less humidity, and a lack of moisture in forest make it easier for wildfires to spread. Globally, many regions become increasingly prone to wildfires, while California remains at high risk. In the past several years, California has experienced 15 wildfire events that were over $1 billion, and 11 of them occurred after 2015. Before 2015, wildfire damage cost totaled $14 billion. Between 2015 and 2021, $48 billion. So wildfires becoming more frequent and more costly, and it is important to understand its impact on our economy. And in my research, I try to establish this linkage and quantify the impact of wildfire exposure on several economic outcomes. So here I show you where wildfires have happened in California from 1997 to 2017. As you can see, wildfires geographically, they're widespread across the state. And most of the wildfires occurred outside of the urbanized areas. And the purple are cities, orange are wildfire urban interface. There are areas with low density residential development intermingled with vegetation. And the gray are wildfire burned areas. So most of the wildfires occurred in wildland urban interface, but the most costly wildfires are those closer to developed areas. In particular, Southern California appears to have higher concentration of wildfire events. And wildfires tend to occur closer to Los Angeles and San Diego than other populous cities in the state. So I link several, so here's the framework to help you understand how wildfire will impact economic activities. On the supply side, the impact is always negative. For example, it causes physical damage to nearby homes and businesses, disruption of operation. And in many studies, researchers have shown that the smoke plume from wildfires can negatively influence human health, which reduce worker productivity. However, on the demand side, the impact might be ambiguous. It can cause more demand for products for wildfire suppression period, more demand for post-fire rebuilding period. And because of the wildfire, people might migrate out of the state. So there might be less demand for local products and services and less demand for outdoor services, such as tourism. So overall impact on the economy is still ambiguous. And I try to quantify the overall impact on several economic outcomes. So I collect county level GDP data from Bureau of Economic Analysis and annual establishment sales and productivity data from Your Economy Time Series database. This is a fantastic database because it provides information about near universe of establishment in the United States, including small business. It provides information like the longitude and the latitude of each establishment. So I can link the location of each establishment with where wildfires have happened in the state. And there are about 2 million establishments in California from 1997 to 2017. And here I show you the location in blue, the location of establishments in blue in this map. Obviously, the establishments are located in populous cities. So to link the economic outcomes and wildfire exposure, I construct 2 types of wildfire exposure. One is city level and another county level. So on the right-hand side panel, I show you the average exposure of from 1997 to 2017. So about 20% cities in the state are to some extent exposed to wildfires, with more than 10 people exposed to wildfires each year. On the right-hand side, I show you the average wildfire exposure at county level. And the gray areas are places with low wildfire risk, and the redder areas are with higher risk. There are about 25% counties in the United States with 500 people exposed to wildfires each year. So I take the data and ran a reduced form regression to study the impact of wildfire exposure on 2 types of economic outcomes, which are establishment sales and productivity, and also aggregate economic outcome, such as county level GDP. So as I mentioned before, my exposure variable is percentage of population exposed to wildfires within a city or within a county. So here are the results. So I found that when an additional percent of population exposed to wildfires, establishment sales was down by 0.2%. Productivity was down by 0.16%. And when additional percent of population exposed to wildfires within a county, the county level GDP was down by 0.42%. So I would like to leave you 3 takeaways. First, I established the linkage between wildfire exposure and several economic outcomes. And I found that wildfire exposure is negatively influencing both business performance and aggregate economic outcomes such as county level GDP. Second, it's important to take wildfire impacts on the economy into consideration when making climate mitigation policy. Last, in the future, we are going to integrate climate impacts into our California model. Thank you. This is my.
Welcome to California and UCLA. Again, technology creates a lot of productivity increases, but you have to be adaptable. So in your program, it says we're going to do a break right now. We are not going to do a break right now. We'll do that just a little bit later because we want to get to our keynote. And so we are very privileged to have Victor Joseph here as our keynote speaker. Victor leads Mercury Insurance's operations, including product management, underwriting technology, and claims. And before being named COO in 2022, he was Chief Underwriting Officer overseeing risk evaluation, risk solution, and catastrophic management, things that we're really thinking about these days. Victor gained deep experience working with teams to solve complex problems that stem from climate change, particularly with respect to wildfires that we just heard some research on. He joined Mercury in 2009 and served in various underwriting, claims, and product management roles before being named to his current role. Victor has been a member of the board of directors of the Insurance Institute for Business and Home Safety, an independent nonprofit scientific research and communications organization that looks at building safety and the insurance issues. He received his undergraduate degree from Harvard University and earned his MBA from here at UCLA Anderson. So Victor is a Bruin. Victor, welcome.
Keyboard.
Technology means that you have to use the down arrow to
Down
advance
arrow.
the slides.
If I want to go back, is it that simple? Cool. That's easy. Yeah, I've never done this before, but that's a little different from a clicker. Hold it the same way, maybe. Okay, everyone, I'm really happy to be here to talk to you about insurance and climate change. I've only got 45 minutes and my slides are always dense. So we'll go ahead and jump in. So we're going to talk about a few different things today. First, we're going to talk about the impact of climate change on insured losses. And then we'll move into how insurance companies in the industry are being impacted, how they're responding. For many of you who do live in California, I think you have an idea firsthand of how companies have been responding. Then we'll transition into how states and the federal government are responding. And finally, we'll talk a little bit about what you and communities can do to respond to the impacts of climate change. Go ahead and jump in. So this is a histogram that looks at global insured losses from natural disasters. It's brought to 2022 dollars. And what you can see here are a few different things. So first of all, globally, there's been about $2 trillion in insured losses this century. And if you step back for a second, in terms of economic loss, the number is much higher. It's actually $7 trillion. The reason for that is most economic loss is not insured in the world. And if you think that's something that is unique to other countries, think about California for a moment, an earthquake, there's only about 13–14% of this state has earthquake insurance. So when you think about that protection gap, it's very significant. It varies by different types of disasters. Earthquake does quite poorly. So when that big one happens, it's going to be quite painful for the state. Now, I'll call out a few things here. You can see a few spikes on the histogram. You might be wondering what happened in those years. In 2005, we had Katrina. 2011, you had the earthquakes in New Zealand and Japan. You also had a super tornado outbreak in southeastern US. 2017, you had hurricanes Irma, Maria, Harvey. Horrible year. And what you can see here is that the rate at which insured losses have grown globally is about 7–8% this century. If you looked a lot further back, it'd be closer to about 5%. And the last 6 years here have all been above the average established by the first 15 years this century. So clearly an acceleration in what's happening. 2023 is not here yet. I can tell you already it will be another year above average. So let's look at a bit more deeply at what's driving this in terms of the types of disasters or perils. In the industry, they're often referred to as perils. So as you could kind of gather from what I said earlier, that purple line hurricane or tropical cyclone, that is the big one. That has been the big one this century, but there have been some other shifts as well. And in the green line, you can see, particularly in terms of counts of major events, severe convective storm is really showing up in a very different way in the United States and globally. Severe convective storm, by the way, think hail, think tornadoes, straight line wind, lightning. It's mostly hail. That's a main component there. So there are two main things that we'll explore today that are driving this acceleration in loss that we're seeing globally, but we'll focus mainly on the United States. First thing is climate change. I don't think that should be too surprising, but with most of these natural disasters, we believe very strongly that the research supports climate change as an impact or as a driver of this acceleration in severity and frequency. The field of attribution science is still, I would say, relatively young. Most of the research has been published since 2017. But you can see with almost all of these events or types of losses, climate change is going to make things worse over time. So let's drill down a little bit and focus on wildfire. Kind of prove the point and examine it in a bit more detail. I'm going to skip through this one quickly because we just had a little bit of a deep dive on wildfire that I think does a fantastic job. But what I will say is that in California, of the worst 20 events in California's history, 13 have happened since 2017. So there's been a real acceleration in terms of acreage burn, in terms of the severity. If you live here, you've seen it firsthand. If nothing else, you've experienced the poor air quality. So what's driving this? So I'm not going to read through all of these. There's a range of things that are influencing it for the worse. And the one that I think is most important, most significant to really highlight the connection between climate change and wildfire is something known as vapor pressure deficit. Yes, the forested lands, the 30 million acres we have in California, haven't been necessarily maintained as well as they could have in hindsight. Yes, there's more development in the WUI, which wildland-urban interface that was brought up earlier. There's a number of other inputs, but vapor pressure deficit is really the key for the long term. Vapor pressure deficit measures the ability of the air to really extract moisture. So it's how thirsty the air is. And basically, as it gets warmer, the air can hold more moisture. As the air can hold more moisture, it will pull more moisture out of plants and fuel, make them drier, make fires more intense, make them burn larger and more frequently, which you can see down below. If you look at a specific season, 2020, we had two very large fires that year. The August complex fire was the largest fire in California's history. And if you look at the black line, the observed line, and for August and Creek, you can see vapor pressure deficit was really high during those periods. Now, where is this going? So this is a study actually from UCLA. So I felt I had to include it. It's have to give a little bit of a shout out to the folks here at UCLA. What this study did was it looked at the amount of the increase in vapor pressure deficit that you can explain through normal atmospheric circulation. So think about normal weather cycles that you have, and up there that's labeled as analog. But then there's this very large residual that cannot be explained by normal weather patterns. And what they found was that in most of the Western United States, they can draw a connection between human activity-driven climate change and this increase in vapor pressure deficit that we've seen, particularly since the year 2000. The year 2000 has been something of a turning point with wildfire. That's when things really started to dry out. You started to see more of this hot, dry, and windy weather that has really created some very severe events in California and elsewhere. The scary part here is that when you look at their projection, which is below in that black line, you can see this continuous slope upwards over the next several decades, which means, in short, climate change will lead to worse and worse wildfires. They project, I think this was actually another study, projects an increase in fires in terms of the damage and the acreage of about 3 to 50%. It's a big range. It depends on how much the temperature increases, depends on how much you have fires overlapping in the same areas repeatedly, because as you have one fire, subsequent fires in the near term tend to be less severe because there's not as much fuel to burn. But the point is, things are looking poor on this front, and they are for most types of natural hazards or disasters. Now, there's another driver behind what we're seeing in the increase in insured losses. And to examine that, we're going to talk about severe convective storm, which, if you remember from earlier, that was that green line that was quite steep in the last 15 years. And it's become an increasingly large share of losses in the United States. These are losses for the whole country, by the way, the whole industry. This is not Mercury's data. I'll call out when it's Mercury's data, but if we had over $1 trillion in losses, I think we'd be in trouble. So that's for the whole industry. And you can see that increase in severe convective storm, particularly in the last 10 years. This doesn't have 2022. That was a year, probably the third worst year in history. This year will probably be the worst year in history. I think it already broke 50 billion. Year's not over yet, but quite a challenging form of disaster for the industry and society. So what's happening here? Now, when you look at the science here, this is the one natural hazard where we're not really sure yet the extent to which climate change is driving increasing severity and frequency of events. The science here shows some mixed and offsetting effects. There's some competing interactions. So there's a variety of things that might make it worse. There's some things that may make it better. A hail or severe convective storm is quite a complex peril, but I do think over the next several years, we'll understand it better. Now, one thing we can look at that we know has driven it significantly is in looking at what exists underneath these storms or in the path of these storms. And to put it really simply, there is a lot more stuff underneath these hailstorms or in the path of these tornadoes. That stuff has gotten more valuable. Population trends have contributed to that. And that explains much of what we're seeing with this increase in severe losses from hailstorms. So let's look at that a different way here. This is a chart here, or a map that shows population growth by state. And you can see the states that are in red have seen the most population growth over the past 2 decades. And if you look at Texas, Florida, areas of the Western United States, they've really stood out. If you take a closer look at Texas, and you look at a hypothetical example of a hail swath or a footprint, you can see it there with that kind of red shape, that curve. And you look at how a place like Dallas or the Fort Worth Metroplex has grown over the last several decades. If you imagine that same hailstorm happening at different points in time in history, you can understand how hailstorms now are contributing to much, much more significant losses. And this is something that will continue. And this doesn't just apply to hail. If you look at other types of natural disasters, and you think about the hurricanes we've seen in Florida, we've seen just nationally a pace of densification and expansion into areas of the United States that are more exposed to natural disasters. And this has been much faster than average. The fastest we've seen population growth is into areas that are exposed to wildfires. That's 10 times faster than average. And natural hazards cover about 1/3 of the United States, but about 57% of structures in the US are in those areas. So the path where Ian went through, and you can see it in the image on the left there, that portion of Florida that was hit hardest had grown at a rate of about 600% since 1970, much, much faster than the national average. So this is a significant problem that we're facing now, and it's a big factor in what's driving the increase in losses and the pain for the industry and society as a whole. So we're going to talk now about what insurance companies are doing about it. And I think to do that, we need to do a very, very quick primer on how insurance companies make money. So this is an image that shows a breakdown of $1 collected in premiums and how it is allocated internally to different forms of expenses or profit. So there's 2 ways insurance companies make money. First is on the underwriting. It's on the core insurance business. Most of the money that insurance companies take in, about 2/3, goes into paying claims. Attritional loss are non-catastrophe claims, lower volatility, generally speaking. Catastrophe loss is what we've been talking about. High volatility, companies need to provision more for that in different ways. The remaining amounts, you have loss adjustment, which are expenses to adjudicate those claims, adjusters, inspection, litigation, defense, a variety of things there. The 24% there, variety of fees to operate the business. 4% is roughly what a lot of companies shoot for in terms of profit. It's not a significant profit margin. In insurance, you're looking for scale. You're not looking to make 10, 20, 30, 40% margins on the business. Now, on top of this are reinsurance costs. For those of you who don't know what reinsurance is, it's basically like insurance for insurance companies. We take the high volatility risks and we transfer part of that to other insurance companies so that we can protect our capital. So it's a risk transfer mechanism, much like what people do when they buy insurance on their cars or their homes. Now, the other way insurance companies make money is investment income. You bring in money, you invest that, you make money off of that. That's pretty straightforward. That's often called the float. That's an important part given how insurance companies have performed over the past 20 years. So if you look at homeowners insurance in the United States, for the industry as a whole, over the past 20 years, it hasn't done so well. So the orange line there you see at 100%, that is the break-even line. A number above that 100% means that insurance companies lost money on the underwriting on the core insurance business. And you can see that in many years, that's been the case. Okay, and if you look at the last 6 years, they've been either at or slightly above that limit for the whole time. But there is the investment income, although I will say it's a little bit risky to rely entirely on investment income. And I think with what happened with asset prices and the markets last year, that was a painful experience for a lot of insurance companies. But they'll recover as the yields increase on their fixed assets, or their fixed income, I should say. So staring at this, it doesn't seem like a whole lot has changed. But at the same time, you're seeing significant rate increases. We're seeing rate increases of 20 to 40% entering many states and markets. That's on a book that normally increases about 5 to 6% per year in terms of the pricing. So dramatic acceleration there. What you're also seeing are insurance companies restrict their writings in many parts of the country. If you look at California, if you look at Louisiana, Florida, Texas, these are states that you'll hear and read about. And again, for those of you who are here, you may have experienced it firsthand. There's quite a bit more pain in terms of the availability of insurance in the market. A few weeks ago, the California Department of Insurance released this image on the right that looks at what the top 12 companies in California have done on the homeowner side. And you can see in that rate increase column, a lot of rate increase right there that's pending. California is a prior approval state. There were 13 states where insurance companies need to get approval before they can adjust their prices. California is one of them. And you can see all the way to the right, kind of that orange font, it might be a bit hard to read. Many companies have imposed restrictions. They're no longer writing, they're non-renewing, they're cutting down certain areas. So it's been a very, very hard, challenging market, especially in California. Now, all that said, as I showed you earlier on this slide, the bottom line hasn't changed all that much for insurance companies. So there must be some other things going on. And I already talked about climate change. I talked about what happened in the markets briefly. There's another thing happening here, and it's probably been touched on endlessly at the forecast, which is inflation. So if you look to the left there, you can see the annual change in vehicle repair costs, and this is actually Mercury's internal data. And you can see for many years, we ran at about 3% in terms of the annual change in vehicle repair costs. But in the past several years, we've seen that accelerate rapidly. Part of that is driven by what Jerry mentioned earlier. Newer cars are quite a bit more expensive to repair, but at the same time, the average vehicle is about 12 years old, which I think it's the oldest it's ever been, vehicles on the road. So much of this is driven by shortages, by increase in labor costs, by increase in part costs. That's created quite a squeeze, and it's also led to much longer lead times to repair vehicles, which has led to other expenses like paying more for rental cars and other things, and that all rolls into insurance companies needing to increase their prices. The reason I talk about vehicles here is personal automobile insurance is by far the largest market in the country. It's 2.5 times larger than homeowners insurance. So what happens on the auto has a very big influence on what companies do overall if they have a personal lines focus. On the right side, you can see some data on the increase in construction materials. So this applies more directly to homeowners insurance, property insurance. I don't think this is surprising when you've heard about what's happened with lumber, with plywood, with copper over the last several years. But there's been a significant increase there that needs to be recognized in the prices that insurance companies charge. Now, when you step back and you take auto and home combined, the picture looks a little bit different. So it still doesn't look very attractive in terms of the bottom line for insurance companies, with the exception of a few years. But in terms of how bad it was in 2022, this is the worst year, 2022, that the industry has seen for personal lines in about 20 years. It's a very unusual situation. And again, that's against the backdrop of climate change. That's against the backdrop of population shifts that are having a significant impact on the forward-looking view that insurance companies have around the world, but especially here in places like California. Okay, you don't have to be able to read this, but the point of this slide is reinsurance. So I mentioned reinsurance earlier. So if you think about volatility, you think about what's happening with climate change, there will be increased volatility. And for insurance companies, that means we need to buy more reinsurance. We want to buy more protection against severe tail events. And if you look out 20, 30 years, that becomes more of an important issue. Now, this is Mercury's reinsurance program. And all that you really need to be able to see is the blue. The blue has gotten larger and larger. That is our reinsurance tower. That is the amount of insurance we're buying for protection against tail events. And back in 2017, it was about $200 million. Now we're at over $1 billion. So that's how the industry has learned through some pain where things are going, what's happening, and how we need to be better prepared for it. Now, a few other things are happening here. You can see at the bottom right, maybe you can read it, that's the cost of our reinsurance. That has increased significantly over the past several years. Now, part of that is because we are buying more coverage. But another factor at play here, everything I've mentioned about inflation, natural disasters, markets, that has the same impact on reinsurers, and in a very painful way. So they've been running at significant losses for the last 5 years. They've taken a big hit in the market last year. So they've raised their prices significantly, as much as 30 to 40%. They've reduced coverage. So if you look at the bottom there highlighted in that kind of red rectangle, you can see that we're retaining more of the loss. And in a sense, our deductible has gone higher. So these are costs that insurance companies have that they need to find a way to pass along to the consumer. This is kind of a summary of the different pressures I've mentioned so far that impact the insurers. Again, you have some near-term headwinds with what's happened in the markets. You have significant inflation. Longer term, you have things like population shifts, climate change. All of those create pressures on the entire industry, and much of it's flowing through right now in the form of increased prices and/or reduced coverage. And I think when you look at it this way, it's sort of a bleak, you can have sort of a bleak view of things. And I think when I've talked to people about this, one of their first responses is, sounds like a really good industry to short. But I think there's another way to look at it. And I often think about a phrase I remember seeing a lot in school, ceteris paribus, this Latin phrase you would see as like an economics disclaimer that would say, holding all else constant or holding all else equal. And I think if you do that here, it does look quite concerning. It's quite scary. But I think the upside, like the good story that's here that we need to focus more on is we don't have to hold all things constant. And not only that, we can't. We really can't afford to do that. So I'm going to transition now to talking about how the state and the federal government are responding to what's been happening. So about 2 weeks ago, the commissioner of the California Department of Insurance, Commissioner Lara, came out and spoke about a range of changes that he's making to stabilize the insurance market. And I'll talk briefly about 3 things that he's doing. The first thing is reinsurance cost recovery. So California is one of only 3 states in the United States that does not allow insurance companies to transfer or include their cost of reinsurance in pricing. And as you see the effects of climate change and reinsurance costs go up dramatically, this starts to create a greater and greater problem for companies that want to sell a lot of insurance in California. They have no means to pass along those costs. From what I've been told, the traditional view was that they could take it out of their profits, but I think you already saw that those aren't really existent over a longer period of time. So that's a change that the commissioner is exploring with some conditions that will be positive for the industry and for the state. Forward-looking catastrophe models. California is also one of 3 states that does not allow insurance companies to use catastrophe models that are forward-looking. You have to look in the rearview mirror in California when you are pricing for catastrophes like wildfire. Well, if climate change is real and risk is increasing, and insurance companies have no means to adjust their prices based off future risk, that is not economically viable in the eyes of some companies. So that is another area. The commissioner is someone who is very focused on modern methods, science, and on climate change. And I think he really believes in modernizing how the state approaches our problems on that front. The third thing I'll mention is rate increases and rate approvals. So I mentioned earlier there were 13 states in the United States that have prior approval regulations, meaning you have to submit a price increase to the state to get your rate approved before you can do that. California is by far the slowest state to approve rate changes. So if you are seeing significant inflation and significant shocks, and you have to wait almost a year to get your prices changed, that creates quite a squeeze on insurance companies in the interim. And the commissioner on this front is going to make some changes that I think will help insurance companies submit more of the information the department needs to get these rate changes approved quite a bit faster. They're also adding the staff. So those are 3 changes at a high level that the state is making, will be making over the next few years that I think will do a lot to stabilize the market. And I think with the governor's support, the commissioner is moving in the right direction. And I think it took courage to move down this path to make some changes, because a lot of this has been this way for decades. And he's received some pushback on that front from different groups that have a variety of interests. Okay, so let's zoom out a little bit and talk about what the state is doing as a whole. So there's quite a bit on this slide that you can look through. The point is California is investing a lot. Private stakeholders like utilities, or various stakeholders like utilities, are also investing quite a bit and bending the risk curve and not holding things constant. So on the left side, from a budgeting standpoint, the state has allocated quite a bit more money, over $1 billion recently, to continuing to invest in fire suppression, things like more planes, more helicopters, more advanced helicopters. California has the largest private fleet in the world for firefighting. It's It's quite impressive, actually, what they're capable of doing. But beyond that, you have more prescribed fires, you have field reduction plans, you have vegetation management, whole range of things happening here that will move the needle, but it will take time. It's one of the main caveats with everything we're talking about at a state and federal level. It will take a long time for some of these things to pay big dividends, but some of them are paying off quite a bit faster. And the work that some of the utilities are doing over the last several years has been quite aggressive. They've invested billions of dollars in hardening their infrastructure, modernizing their equipment, burying power lines, because utilities have caused about half of the major fire events in California over the last 5 years. And of those half, many of them are the big ones. They usually happen, they're usually tied to the biggest events. So they're taking a lot of action there. They're protecting their infrastructure. They're updating their equipment. They're improving their modeling. The state is as well. We can better predict where a wildfire is going to happen. We can better pre-position people, and we can make better decisions to get on top of fires quite a bit faster. So really good things happening at a state level and with the utilities to move the risk down. At the federal level, so the federal government looks at about 350 million acres in the Western United States, and it wants to start tackling the risk in a variety of these areas. California is one of the states where it wants to put additional focus. It's allocated about $5 billion from that, what is it called? The infrastructure, $1.2 trillion plan they passed back in 2021, Infrastructure and Jobs Act, something like that. It allocated about $5 billion from that to wildfire management. And they've identified about 16 million acres in California that they want to target, but they're going to focus on about 1 million first. They're doing a lot of that through shared stewardship, which means they're partnering with the state officials, tribal and private entities, because forested lands in California, that 30 million is chopped up between federal government, the state, and others. So partnership here is quite important. So there's a lot of good things happening that I don't want to discount. I want to make sure that we highlight on this front. Now, and you can see here, those are the fire sheds, those little red little bubbles. Those are areas that they've identified that they want to put much greater emphasis on. And you can see it covers quite a bit of the state of California. So a lot of work to be done there. Okay, so I want to transition here to talking a little bit about what people can do. What can regular people do who own homes or property or businesses? What can communities do? And there's a variety of things that you can do with every natural hazard that we face as a society. And I'm going to focus a bit more on wildfire, because I think it's more relevant here, and I only have enough time to go deep on one natural hazard. So we'll do it with wildfire. So wildfire is a really interesting type of natural hazard because the amount of destruction it causes within a fire footprint is unusually severe. It's especially true in Northern California. There are reasons for that in terms of the housing stock, the layout of neighborhoods, a whole range of things which we won't get into. But with most natural catastrophes, you don't see landscapes like this that look completely flattened, completely destroyed. And the reality with wildfire, when they're really bad, is they aren't really wildfires when they cause this kind of destruction, not when they get to the towns. They're urban conflagrations, which is a little bit different. And the fuel that moves a fire and destroys these entire cities is the homes themselves. Okay, it is not forested areas far away anymore, but is really moving across. And if you look at Paradise, where the fire moved very fast, it covered 80 football fields a minute. Okay, think about the rate of spread that it had. It was moving from house to house to house to house, and you had embers flying across that whole town. Embers cause ignition in about 90% of the homes that are destroyed. It's not radiant heat. It's not a fire that's slowly moving across the ground. It's wind driving embers across an entire region, causing all these different spot fires, breaking past protection lines, creating all sorts of havoc all over the place. And it just overwhelms the fire suppression resources rapidly. And that's what happened in this fire. This was the Tubbs fire in Santa Rosa. Now, one thing that you'll see often as people do sort of a post-mortem on these events are these miracle homes. And many of you have probably seen this photo. This is from Lahaina in Maui. This was a home that survived, and you can read quite a bit about it. And some of the reading on it attributes the survival in part to luck or divine intervention. And I'm not discounting those things, that always helps. But the reality is, when you look in detail at what's happening with that specific house, why it survived. It was what they did with the home. Okay, so resilience and mitigation is really what's leading to these miracles. And it's something that we don't talk enough about, and society at large is not doing nearly enough about to be prepared for the impacts of climate change. So, Wildfire Prepared. I don't know how many folks have heard of this. This is a new program that was launched last year that provides homeowners and communities in California and elsewhere with a lot of concrete, scientifically backed, research-backed guidance on what they can do to make their homes and properties safer. And this is something that is really important. It doesn't come up enough, but I think we have an obligation to talk more and more about this. We have an obligation to bring this into our building codes and the standards that we use as we construct homes in California. So there's quite a bit you can do with a home, but really it's about getting rid of anything that can burn on the exterior of the home or in that 0 to 5 foot range around the home. That defensible space, that ignition zone, that is a very significant form of exposure for homes. I mean, you can have a great roof, you can have done a lot of things on the house itself, but if you don't have defensible space, you're going to have embers pile up against that home, and you are likely to have a fire start. It's just something that I think sometimes when we talk about wildfire, we don't understand that you have to imagine almost like a rainstorm that's coming in horizontally, but the raindrops are made of little sparks of embers. And these embers can fly 4 miles. They can go really far. So if you're thinking about clearing vegetation that's 100 feet away from your house and you're going to be okay, it might not really matter because the house 30 feet away from you might ignite. And then that's pushing embers all over the place. So that 0 to 5 range is really important. I can't emphasize that enough. It's something that we've been giving a discount for many years now because we're quite fanatically obsessed with what are they doing right up against the house. Now here is what happened to my little photo. Oh, that's too bad. Okay, well that disappeared, but there would be a photo here. I'll try to speak to it. No, that's not going to work. I can't do it justice. Okay, we'll come back to that. What I'd like to do is show you the power of mitigation and resilience, what these things do at scale. Okay, because a lot of this seems like theory. How does this actually play out? Has it been tested? And what I'd like to tell you is that it actually has. And again, it's a story that you will not read about. You will not read about this in the papers. What you'll read about is how bad the fire was, but you won't really read about why it wasn't such a bad result. So this is the Silverado fire. In red, you can see the footprint. This was a fire in Irvine back in late 2020 during the height of the pandemic. It created a lot of uncertainty in terms of how the fire suppression resources or the firefighters would deal with a fire. And this is one that started in Silverado. It started moving down the hill early in the morning, 40 to 50 mile an hour winds. It was all the right ingredients for a very horrible event. And you can see a quote there from the Orange County Fire Authority chief talking about how difficult the conditions were. Now, there is a neighborhood that was right on the front line of this fire called Orchard Hills. And Orchard Hills, to me, offers a very compelling real-world example of how we don't need to hold things constant in the face of climate change. So this community was designed in partnership with the Orange County Fire Authority. And if you look at how they built it, they built layer after layer after layer of protection and mitigation that had an incredible result. They maintained the fuel around the entire community. They kept it trimmed, they kept it irrigated. They chose specific types of plants that were less prone to burning. As they got closer to the community, they built it on a different type of mound or hill that helped defend it against ember intrusion. They used radiant heat walls. They built every home on the perimeter, which there you can see in that lavender color, to an extremely high standard. They built it above code. Okay, and everything from the doors to the windows to the eaves to the gutters to the roof to the defensible space, they were really fixated on lowering the risk dramatically. And beyond that, every home in the community that you can see in that taupe or beige color was built to a very high standard. It didn't have quite as many things, but there they were more focused on ember mitigation. On the perimeter, they were more focused on radiant heat and ember mitigation. So this was a community that was built with very significant planning. It was very deliberate. It was a very strong partnership between the fire authority, the builder, and the community. And this is a community that has been vigilant about maintaining their defensible space year after year. Because one of the things with wildfire or just owning a home in general, you can't just do it once and forget about it. You have to continuously maintain things. Things will grow, things will break down over time. You have to stay on top of it. And they've done that. Their CCNRs enforce that. So they have quite a bit of teeth there in terms of how they manage their community. Now, this is the community here, and you can see it almost enveloped by the fire footprint. And the two red stars are two fire trucks. The Orange County Fire Authority was so confident about all the investments they had made with the community in preparing this place for a wildfire that they only sent 2 fire trucks. Okay, and the third person who went was the assistant fire marshal who had worked on that neighborhood, and he went there to observe all the hard work they had put in to see what would happen, and they just let it burn there, and not a single home was lost. So this is a very interesting story to me. It's very compelling. It's one that comes out of really not taking things for granted, focusing on mitigation, and understanding that with natural hazards like wildfire, you can win the battle before it even begins. So it's a model in my mind for how we can do things more broadly throughout California when it comes to wildfire. Now, when you look at what we take away, oh, I did want to show this photo of the actual community. We went to visit it recently. And the reason I show this photo is I've gotten questions from friends from time to time about how do I do this and not have my home look really ugly? Because that's always a concern that people have. And I think sometimes when people think about a place like Orchard Hills and you look at this, you probably, like in my mind, people are thinking about, I don't know how many people are, well, everyone knows Star Wars, but Tatooine on Star Wars, like you think about this barren wasteland, it's nothing but dirt and these like concrete igloos. It doesn't have to look that way. Like look at this community. I think it looks quite nice, right? So you can do things. You manage the tree separation vertically and horizontally. You choose the right plants. You choose the right spacing. There are a variety of things that you can do to achieve a great outcome and live in a great looking neighborhood. And the best part is it doesn't burn down, right? So that's a really, really big benefit here. Now, looking at what we did talk about, the kind of information that was published after this event occurred, there was an article in the LA Times that reviewed this. And out of 1,142 words, they gave 10 to communities being built under a more recent fire code. Most of the article was focused on mutual aid and the heroic actions of the firefighters, which are a factor. Don't get me wrong, that is significant, that's true, that's an important ingredient. But the reason I'm showing this is I think that we overshadow, we kind of shortchange ourselves when we don't talk about what communities like Orchard Hills have done. It's such a good success story. It's very hard to find information about it unless you go to the Orange County Fire Authority and say, what happened here? And then they're happy to tell you. They're happy to tell anyone who will listen. And from their standpoint, they've been talking about this stuff for decades. It's only recently that people are willing to listen. And they think it's because their insurance availability and pricing has been really under strain lately. Okay, so a lot of this flows into building codes. I talked briefly about building codes earlier. Building codes in the United States have a lot of opportunity. It's one of the best mechanisms that we have to build more resiliently, to impose and create more opportunities for mitigation on new construction or reconstruction or redevelopment. California is a state, you can see in dark blue there, it does have a code, and the code works quite well. It's called Chapter 7A, that's the one that focuses on wildfire. But if you look across the country, we actually don't do very well from this standpoint. Most states either don't have a code or they don't enforce it, which in my opinion is not that different from saying you don't have a code. This is going to become an increasing problem for America, and in particular the states that are more lax with this. One of the reasons that you see some resistance, I think, to more building code advancement and modernization is there are concerns about building costs increasing up front. But the longer you kick that can down the road, the more you're going to have to reckon with the outcomes. Again, this is against the backdrop of climate change, which is worsening things. And I think that you're really seeing that come to a head with the National Flood Insurance Program. So I'm not sure how many folks are familiar with what's been happening with the NFIP, but for about 50 years, they've focused mainly on affordability over solvency. Their prices have been artificially suppressed for decades. And recently, they've rolled out a new rating plan that is based more on where the world is going from a climate standpoint. It uses more advanced modeling and research. And unsurprisingly, it means that people have to pay more. And in some parts of the country, they have to pay a lot more. In Louisiana, you have people who have to pay 700% more for insurance now. What that's going to do is it will cause significant disruption for those individuals. It will reduce the value of their homes. But that, frankly, is coming from not having recognized the reality of the risk soon enough. And that's what will keep happening here. I mean, CAL FIRE, so the building codes in California are enforced generally where CAL FIRE has designated parts of the state as higher risk. And they built a map for that back in 2007. And that map was the same map for the last 15 years. And from my standpoint, changes should have been made there sooner, but there's concerns about that. Again, there's concerns that if we change the map and more of California looks risky, more people have to adhere to those building codes. We have to spend more money on upfront construction. But again, there's the reality of what you're facing. And if you believe climate change is real, you also have to respond to it in a manner that's realistic. To me, it's like second order climate denial. Like that's kind of how I look at it is you have to deal with the effects of climate change if you really believe it's real. You can't dance around things like building codes forever. Otherwise, you'll create greater problems. And the National Flood Insurance Program is being sued by 10 states to stop it from charging the right rates. So how's that going to play out? It doesn't really make sense. I mean, they're $36 billion in debt. They have not been charging nearly enough. And you have thousands of people who live in homes in areas exposed to flood. They've been flooded more than 10 times over the past 50 years. But we keep doing it. You know, it's concerning. It's concerning with where we're going. Now, the good news here, and I think it's something that you want to put in front of elected officials and leaders more often, is that when we talk about these things with wildfire, when we talk about investments in mitigation at a community level, the cost-benefit analysis is quite attractive, not just on wildfire, but on a variety of natural hazards. And this is a really, really solid study from the National Institute of Building Sciences from back in 2019. Very comprehensive. But as you look at the cost-benefit, or they call it the benefit-cost ratio, you get a very strong return on your investment when you invest in adopting codes, going beyond codes, doing retrofits, using grants. There's a variety of different mechanisms that we can use to really improve the resilience of our housing stock and our businesses. And it's something that we have to do. Things will get worse. I mean, I suspect that you do this study again in 10 years, you'll find that the benefits may have been greater. And I think it's something that when you help people understand that you might spend a little bit more upfront to build that house, but over the course of many, many years, you will realize savings on your insurance. And it just so happens that when you build to a higher standard, they're usually more energy efficient. So there are other benefits too. But I think mitigation is really a really important message. It's a really powerful solution. It won't solve everything we're facing from climate change when it comes to housing, but it's a very powerful input. And it's something we need to do more of, not just for where we're at right now, but for future generations. I can't emphasize it enough. So that's kind of what I wanted to end with here, leave you all with today. And am I allowed to take questions, or I got 2 minutes, I think. Too little time? Someone tell me what to do. Sure, yeah. Sure. Well, generally what you're seeing is insurance companies are increasing their prices significantly. They'll reduce availability in some states. In some states, they're going insolvent. So I think that will happen at a continued pace, and it will increase in areas where the real risk becomes further and further delinked from what insurance companies are allowed to do about it. And what you'll see as well is more people will roll into residual plans. California has the FAIR Plan. The FAIR Plan, maybe many of you have heard of, that's doubled in size over the past 5 years. That's going to continue happening. But insurance companies, in my opinion, can't really influence elected officials alone. I mean, we can do things like we can lobby We can provide significant discounts and incentives. We can try to work with communities. We can try to work with individuals. And that's much of where we're focusing our efforts. But some of that comes down to people electing folks into office who believe in it. I mean, 8 out of 10 Americans believe that their building codes are at the right standard. They're not. And I think if they find out what's going on, and that's actually part of that same study, most of them are quite concerned about that. About 85% of them are quite surprised to find out and concerned that it's not, because they put a lot of trust and faith in the elected officials and leaders and lawmakers to do what's necessary from a building code standpoint. But there are competing interests on that. I think understandably people are concerned about building homes at a greater cost and how you'll have to manage that. But from my standpoint, you're going to pay one way or the other, and you're going to pay a lot more if you don't do the right thing here. They're based on both. So it varies by different companies. States, California's put in more requirements to offer discounts at an individual and a community level. And that's something that we've been doing for years, because it is true, there's a lot you can do as a homeowner, but if your neighbor has done nothing, it puts you at significantly greater risk. And in the Oakland Hills fire back in the early 90s, I think they found that the average wood shake roof, which is a really bad roof to have, by the way, especially if it's not treated, contributed to the destruction of 10 other homes. Right, so what you do in terms of being neighborly is really, really significant here. But we provide those discounts at both levels. I mean, there's a lot of research to support defensible space. Usually you see the amount of destruction go down by half with homes that have significant defensible space, and you start to get network effects when they're all grouped together. And we saw a block in Paradise when we visited where every home except for one had done the right thing. And that little group had survived when nothing around them had. And it was really striking to see something like that. But we looked at that and said, how do we incent that? And I think we're really passionate about that, but maybe it's a bit utopian to think that communities can kind of come together that way. I will say we visited a variety of them throughout California that even though they could smell the fires, still don't seem to feel a lot of urgency to invest in mitigation, which means we have more work to do to educate and influence others. Yes. Yes, I do. I think that depending on how the Department of Insurance implements the changes I mentioned with reinsurance, with catastrophe modeling that considers climate change, you'll see companies rush into the fray. And the FAIR plan is about 3% of the market right now. So overall, it doesn't feel huge, but in parts of California, it's very significant. It's really the only option. Yeah, so I'm pretty optimistic about what the commissioner and the governor have laid out. I think that there will be conditions. One of the conditions they've outlined is they want to see companies take a minimum amount of the market across California to be able to recover their reinsurance costs. And I think depending on how that's implemented, I think that's a reasonable requirement for the industry to meet.
Thank you, Victor.
Yeah.
Please join me in thanking Victor for an incredibly fascinating and informative talk.
Yeah.
So thank you so much.
Yeah, thanks for the
Okay.
time. Happy to be here.
We're going to take a 10-minute break so that the panelists, and we have a great panel coming up, so the panelists can get mic'd up. We're going to start promptly at just about 11:10. Hey, can I ask you to move back to your seats, and we'll start the second part of the program. Okay, we're ready for the second part of the program.
Good luck. ULI advisory board.
I'm sorry. LA.
I am, but I like never show up.
Yeah, I haven't seen you.
I'm still on it, but like, it's like I cannot miss another morning of my.
No, I know. Same as me. She's a friend of mine. Good to see you.
Is everybody mind? Definitely. Sorry.
Okay, we're ready to start the second part of our program, and we have a great panel coming up. It's my pleasure to introduce the moderator of the planner, my colleague Magali Damas. Magali is a distinguished professor here at UCLA and at UCLA Anderson. And with the Institute of the Environment here is the faculty director of Impact at Anderson, widely quoted for her research. And it's just a pleasure for us at the Anderson Forecast to partner with Impact at Anderson and yourself for this conference. So let me turn it over to you, Magali.
Thank you very much, Jerry. It's a pleasure to be here. And what a fantastic, the fantastic presentations before. It's actually a hard, act to follow. But so we are going to talk about the future of sustainability reporting. We've heard a lot about what's happening with, climate change. We're all aware of the incredible economic impact that these have. So the question now is, what are companies doing about it, right? And how do we know about what's happening within businesses? So it's about disclosure. It's about providing information for stakeholders, shareholders, employees, consumers, communities to kind of understand what is happening within businesses and as we will hear from this fantastic panel, once you know about your footprint, what you're doing, it's going to be easier to kind of make changes. So, and this is working, yes. So talking about sustainability and ESG, in 2023, at the Center for Impact, we are collecting data to understand what firms are actually doing in terms of sustainability. There is about from $8 to $17 trillion right now invested in ESG from investors. This there's debates on what these numbers are, but they are big. And there are debates on what, ESG means, environment, social, and governance. And so, because a lot of it is voluntary, firms are still voluntarily giving information to their stakeholders about what they're doing in terms of sustainability, in terms of the environment, in terms of climate change, in terms of social and governance issues. But things are changing rapidly. We're seeing a lot of requests, a lot of demand, regulatory requirements for firms to disclose this information. Europe is ahead of the curve with requiring firms to disclose their information, mostly on, kind of environmental issues. And so this is about 49,000 companies that are, kind of operating in Europe that will have to disclose information mandated. And we have a couple of weeks ago, this new these laws that passed that haven't been yet signed by the governor, but he said he was going to sign them, which are SB 253 and SB 261, which are asking for transparent and accessible data on sustainability, performance on climate. And then we have the Securities and Exchange Commission, which is adopting, is working on a rule to also ask companies to be, disclosing information about, their carbon footprints and climate risk strategies. So seeing all of this landscape, the question is, are we ready? Are these companies ready? And I think we're going to hear from this, panel, a lot of the initiatives that are already underway. And so the question is, what is the state of current, corporate sustainability disclosure, and so, what needs to be done to kind of comply with this regulation in a very short amount of time. So just a very short brief on what these two regulations are: SB 253, the Climate Corporate Data Accountability Act, and SB 261, the Climate-Related Financial Risk Act. Basically, the first one is asking firms to provide their carbon inventories, including what we call Scope 3. And that's really important. We'll talk about this in more details. But basically, carbon, and this is the federal emergency. How long does it last? What do we do? Should we all cover? Old tuck and cover. Okay. So it's working anyway.
It's working.
That's what we want to see. Excellent. So where was I? Scope 1, Scope 2, Scope 3. It's going back. How many times? Just one. Okay. Scope 1 are all the direct emissions. Scope 2 are all the emissions from electricity use. And Scope 3 is everything else, from the supply chain and from the consumer side. Everything else. So Scope 3 is really kind of important, because these are not the emission that you as a company are emitting. These are from your suppliers or from your consumers. It's outside of your control. Beep, beep. And then in addition to that, not only firms need to actually comply and provide this information about how much they emit, they also need to submit an annual climate-related financial risk report saying, what is going to happen to my company in the future? And as we've seen from the previous, speaker, a lot is happening. And I've seen from even the speaker before, it's hard to figure this out. It requires a lot of data and a lot of information. But firms need to be ready and to think how they will be starting to mitigate this risk. It's not just about, and it's to adapt. It's mitigation, adaptation to climate change. Okay, so just briefly on the Open for Good initiative at the Center for Impact, we're collecting data on what firms are currently disclosing on environmental, social, and governance issues. We're looking at S&P 500 firms. And the idea is, let's see what is out there to see how ready companies are to disclose information and what they are disclosing in terms of, their actual performance on some of these issues. On the environment, we have, of course, greenhouse gas emission, and some of the kind of description from the task force on, on climate disclosure, on, kind of how they are starting to work on mitigating some of these issues. Social is employee diversity, compensation practices, and governance, board competency, diversity, and so on. So we have, kind of issued an index, basically, of the firms that are the most, kind of disclosing the most, the best. And so you can look at our website at the Center for Impact to look at, kind of how much these companies disclose. And so to go into the data, are we ready? So what are we finding in terms of greenhouse gas emission? In the S&P 500 companies, we find out that on Scope 1 and Scope 2, so remember Scope 1 are the direct emission and Scope 2, the indirect emissions from electricity purchased, we see actually that 82 and 81% of the companies in S&P 500 are already disclosing this information. And we'll hear from this panel that they're already doing this and have been doing this for a while. So that is kind of really, comforting. So we kind of know the footprint of these companies. On Scope 3, on the other hand, there's much less done. So I'm saying it's reassuring, but there's some questions about what this information means. And I think it's going to be really important to have this regulation to give us some guidance. For example, on Scope 2, you have two primary methods to calculate Scope 2 emissions. You can have what is called location-based, based on the grid, that's where the company is located, and the generation mix of that specific grid. And you can use that information or market-based. A lot of these companies are contracting they have specific contracts in terms of, they're negotiating with utilities, and this might differ in terms of the amount of renewables than the location-based. So what you can see here right now from the disclosure, we know it's really hard to do. Half of them almost don't have, 38% here have uncategorized. So we don't really know which it is. Location-based, market-based. So you see there are some kind of still some questions. And this is an example with American Express. You can see that the location-based of that company versus the market-based are very different. So being clear on what exactly this information is important. And I think this is going to be coming with this regulation. They will have to be very specific. Scope 3 emissions, so big, kind of questions. This is the disclosure from all of these different sectors in terms of how many of the companies are disclosing Scope 3. Scope 3 is complex. Scope 3 has 15 different categories. And some of these examples here. So this is an example of a company, Becton Dickinson, which is, manufacturing medical devices. And so you can see the categories are purchased goods and services, business travel, employee commuting, which is kind of the things that we understand, the most and are easier for a company to look at. But there's, end of life treatment of sold products. So the product you're selling to consumers, what is their footprint? This is really hard to compute. So you have this company that actually disclosing all of it, but in general, when we see Scope 3, we see a lot on number 6 and 7, business travel, employee commuting, and maybe purchase goods and services if they have been able to get their suppliers to provide information, much less on the rest. And we can see that number 12, end of life treatment of sold products is important. So there's still a lot of kind of holes in the data at this stage. So, now that these regulations are coming, are we ready? So this is what we are going to talk about with this panel. And I'm going to briefly introduce them and ask them to tell us more about the what they're doing in their kind of work life. So we have Eric Wally here from Honda. Is the Assistant Vice President of Honda Motor Company. Sarah Neff, Head of Sustainability at Lend-Lease America. We have Beverly Lagan from Ernst & Young, and Charlie Arazi from SoCal Gas, Director of Sustainability and Managing Director of the Ernst & Young. Different sectors, wonderful experience in sustainability, all of the panelists. And so I'm going to ask each of you to, in kind of briefly, to introduce yourself. And then we're going to ask, more specific questions about whether we are ready, whether you are ready to, kind of comply with regulations and, what we're doing. So please, Beverly, start.
Hi, everyone. Good to see familiar faces. I graduated EMBA 2019 at UCLA, and it's good to be back. Really excited to do this panel. I am a managing director at EY. I'm based in LA, and in the last couple of years have been focused on sustainability reporting with the SEC proposed rule coming up, CSRD in Europe, and even the proposed rules impacting asset managers. So I've been really helping companies navigate the new regulations, analyzing what is the impact to their companies, where the gaps are, and putting together a roadmap and implementation plan to compliance. Happy to be here.
Shirley.
Hi, great to meet everyone today. Thank you for having me. Not a UCLA grad, but was a business school grad. Have been in the utilities industry for 17 years. I work for SoCal Gas. I'm the Director of Sustainability. Had different roles in financial planning, as well as regulatory, and worked in both the electric and gas side of the house. And I'm really happy to be here. I think we've been very, very focused on all three scopes. And so we'll talk probably a little bit more as we get through the panel, but we are serving about 21 million customers here in our service territory. That's about 1 out of 15 Americans actually reside in our service territory. So that is, a really large, footprint for us to solve. And, one of the things we've been doing for many years that we've been very successful at is energy efficiency programs, decarbonizing our operations. But we've, put forward really bold goals to align with our state policies and state goals to get to net zero emissions by 2045. So that's all 3 scopes. So looking forward to talking more about what that looks like.
Thank you, Sarah. So sorry, Sarah.
Hi, everybody. I'm Sarah Neff. I'm the head of sustainability for Lend Lease Americas. Lend Lease is a global real estate company with Australian heritage. So we're traded on the Aussie Stock Exchange. Happy to talk about what that's like. In the Americas business, we are a pure construction business, about 1.5 billion a year of construction. We're also the largest operators of military housing and all of their hotels, about 40,000 homes, 18 communities. And then a pure sort of what you would think of as real estate, raise a bunch of money with foreign pension funds, buy land, develop to own in the long term. So Lend Lease has the most audacious and ridiculous sustainability goals in all of real estate, which is why I like working there. We have committed to getting to absolute zero carbon across every scope, including scope 3. Absolute means no offsets by 2040. Net zero scope 1 and 2 by 25, 100% renewable electricity by 2030. And I'm actually really happy to say that we just published our scope 3 protocol, which is to say, what the heck is in our scope 3? So we've known, yes, concrete's in there, employee flights are in there, but like, is what I had for breakfast this morning in there? Like, I work at the company. So we've actually said, okay, yes, heroes of the 15 categories you heard earlier, which one of those are in and out? And then within those categories, which are the subcategories that are in there? Those categories come from the GHG protocol. They're really hard to navigate. And I'm happy to say that that is published, and that's going to be our framework for reporting on scope 3 in the future, and then working towards decarbonizing that. So really excited about this discussion. Thank you.
Thank you. Eric?
Good morning, everybody. My name is Eric Wally. I'm the Assistant Vice President of Regional Planning at American Honda. So hopefully everybody's heard of Honda, maybe even people are driving a Honda product in here. We're really excited to be here, honored to be here. Thank you very much for this opportunity. It's a really interesting time for us. I'm sure you're familiar, we're an internal combustion engine company, but we're on the precipice of what we're calling our second founding. So we are moving fully to electrification. Our entire fleet will be electrified by 2040. There's some really bold goals for our company. We want to be carbon neutral by 2050. So this conversation is coming at the exact right time. So I think what will be interesting, of course, we're a global company, and I'll be able to give you a perspective kind of from a regional perspective on how to work inside a global company that's trying to meet these challenges. And I think we'll be talking about some things that have a very regional basis today, but I think we're in a place where we're certainly preparing and we will be ready. So very nice to be here with you. Thank you.
Thank you. So you see, we're talking about this new regulation coming in, and we're talking about, companies that have to be transforming themselves completely, changing the fuel you use, changing kind of almost everything. But let's try to, start with this regulation. So Beverly, you're at Ernst & Young, so probably wonderful opportunities for you guys to have all of this regulation and to consult with companies. So what do you think is, are some of the main kind of advances of these regulations, and what do you think, some of the needs that are, that you see from the, from this landscape?
Yeah, I think the regulations that are coming up is a good first step to driving consistency, transparency in the market. I think we're all still navigating what that means, and the SEC proposal, the SEC rule is still in proposal stage, so it hasn't happened yet. There are a number of controversial topics that are still being hashed out. One is data. It keeps coming up that's yes, it's good to have reporting, but what is needed to get there in data is a challenge. Secondly, resources, right? The upskilling of the teams to be able to deliver on the reporting that's needed. Thirdly, tools maybe is one of the what will enable the companies to make it easier to report.
So yeah, data is, I think these disclosure rules, the hope is that, with all this data, all of us, shareholders, investors, and and I mean, employees, all of us can help and be pressure firms to change, and and also because they, well, I mean, you're gonna measure all of things, we'll be able to make these changes. The question is, whether this is sufficient or whether, because there's no cap, just asking companies to, basically tell us what they are currently emitting. But it doesn't say, you should reduce, right, at this point. But there is one industry, I think you are, for the gas industry, I mean, electric utilities, where actually you are required to reduce some of your, kind of footprint. So what are some of the challenges you think in this regulation and beyond for you, particularly SoCalGas?
That's a really great question. You're absolutely right. We're in the unique position being the only natural gas only utility in our service territory in California. There is a number of different proposals or regulations that have come to pass in recent years that do require decarbonization of operations, that do require us to look at alternative means for energy, renewable means for energy, including clean fuels. And so we actually think regulation is really helpful in spurring the development of what we're looking at, which is, renewable natural gas and hydrogen, cleaner fuels to deliver to our customers. Also being unique, our scope emissions are really centered around scope 3. So over 96% or so of our GHG profile is scope 3, it's customer end use. So what can we do as a company to kind of help provide, solutions, and provide solutions that are not all going to fit in one box. So each customer segment is going to need something a little bit different. And so when we think about, the residential sector versus the industrial hard to abate sector, some of the transportation sectors, what are the solutions that clean fuels can provide? And then on top of that, as we see renewable electricity come online more, the intermittency of that kind of underpins how important firm dispatchable power is going to be in the future. And so we see, the combination of the gas and electric grid really complementing each other in that way.
Thank you. So Eric, actually also in your case, I mean, you won't be able to sell, combustion engine cars, in just a few years. So how did you go about this?
Yeah, a tough challenge for us, for sure. So we're recognizing the need to move to electrification. So if you go back a couple of years, I don't think we were quite as prescriptive about how we would be doing that, but we've recognized that society needs it. And for the competitives, almost an existential question for the company, that we need to be more specific about when we're going to do that. So we've outlined those plans. But it's not only the electrification of the fleet that's important, we're also looking at other opportunities. We talked a little bit before, the hydrogen industry, the hydrogen economy is still very interesting to us. We've looked at that for a number of years. We have a fuel cell vehicle that we'll be putting in the marketplace in the very near term. We're really excited about that. The reality is it's pretty low volume, but we haven't given up on hydrogen as a business. So we're thinking about maybe spaces beyond where Honda would have been before, kind of the personal mobility space. I'm looking for different alternatives for fuel cells. Maybe it's heavy duty trucking. It could be data center backup storage, those kinds of opportunities. But we haven't stopped looking at hydrogen investment. In fact, we have a 3rd generation fuel cell that we're continuing to work on. So it's items like that are really front and center for us.
Okay, well, thank you. And Sarah, what about Lend-Lease, response to these, kind of changes and regulations?
Absolutely. And I did drive my Honda here this morning. We are ahead of regulation. And I think any publicly traded real estate company in the US, in US and Canada, in Europe and Australia has had investor pressure for a decade to do all this disclosure before these regulations are kicking. And these regulations are late. I mean, my last company was publicly traded S&P Midcap Index, and we did our first disclosures into the 10K in like 2017. And that was in line with SASB for the Sustainability Accounting Standards Board, and then later aligned to TCFD, Task Force for Climate-Related Financial Disclosure. Now those have joined, so that the investor pressure has been there way before the regulation. So the publicly traded companies are already ready on scope 1 and 2. They are not ready on scope 3. Like I said, we just published our inventory, let alone gotten the data. So nobody is ready to publish meaningful scope 3 data. We publish what we know employee travel. We are, like many people here, 96% as we know it of our emissions are in our scope 3. That's purchased goods and services. That's the concrete, that's the steel, that's all the big, construction materials. And so what are we doing about it? It's really hard. For example, I think the steel decarbonization train has left the station. Steel doesn't have a science problem, right? You got to melt some metal. You can do that electrically and use renewable power for that. Like, cool. Concrete has like 3 science problems, and zero carbon concrete. You can get zero carbon steel now. I don't know if you knew that. It's only like a 2% premium. Zero carbon concrete does not exist. It's a much more complicated scientific process or chemical process. And we're seeing a lot of really great new companies coming in, but it's so much slower than we need. And it's not everything is regionally available. So we were able to replace 40% of what's called the Portland cement, which is the most emitting part of concrete. In Brooklyn with this recycled glass compound, I can't even get that stuff here. Nothing is sort of universally available. So it's really hard. And the other problem is that in real estate, and because there was this pressure on disclosure and not pressure on action, we have a world that's like, imagine a company, you have 10 accountants and 1 person in sales. That's where real estate is right now. We have all these people focused on reporting and disclosure and very few focused on climate action. And until we get pressure around performance, which is you've seen in utilities, we're going to see disclosure without change.
Yes, so I think that's kind of the fundamental question, right? I mean, are these regulations going to make any difference, right? Is it, sufficient to have information? And what are the difficulties for you also to kind of implement them? So you're saying you're just starting, I mean, you've just started to look at scope 3. So Eric also, so what are your scope 3 emissions and what do you do about that to reduce them? So how do you measure them and how do you reduce them?
Yeah, so scope 3 is really important for us when we look at the totality of scope 1, 2, and 3. It's 98% or something like that. And we can see category 11, which is our end product in use, is 80%. So the vehicles that we have on the road are 80% of our scope 3 emissions. And we know we have over 20 million vehicles in use on the road today.
Already.
So part of the problem is we make cars that last a long time, which is great. But now we have an issue that we're going to deal with for a while. So that's kind of one side of the scope 3 discussion. And there are some methods to understand estimations of how much a person is using a car, and we can kind of back into what that means. The other part, the 20% or more, that is scope 3, that is our suppliers, is maybe the more interesting because it's going to require more of us. So the good news is, over our long history, we've had really good relationships with our suppliers and our supply base down into the deeper tiers. But what we're seeing is there's going to be more scrutiny and regulation and understanding exactly what those suppliers in the deeper tiers are doing and what their numbers are. And the reality is, as you get deeper into the tiers, it gets more difficult to get that information and have it be accurate and valid. But that's the exact thing that we're being asked to do. So I see this thing is
So you're basically pushing it to the suppliers, tier 1, tier 2, tier 3. And there are some sectors, I mean, I'm thinking construction, where it's really hard to get that information, where you have very, very small, suppliers. But I feel that like these regulations, because they are, so the SEC is not sure that they will require scope 3, right? That's probably, and you probably know more than me about this, but California moving ahead in scope 3 is saying, well, you need to kind of get the information from your suppliers, and your suppliers are going to ask their suppliers, and their suppliers are going to. So even if at this point, I forgot what the exact number of companies are going to be impacted by this regulation, but I guess everyone will have to report, because every company will have a consumer, a customer asking them to report. And so in that case, this regulation, I think, are a sea change, because it's not just asking these companies that are operating in California, which we don't really know what it means at this point, I think.
That's right.
We're still, I think the California Resources Board, which is going to be deciding some of that, is going to be getting a lot of lobbying from companies. I'm not here. But in fact, you are here in any way, because, kind of the California economy is, still the biggest in the United States as a state. And, kind of suppliers who are not operating in California will have to actually also kind of respond to the demand from the customers. So this California regulation we're going to have an impact throughout the United States. Then the SEC, I think business is easier. Oh, and by the way, it's not just publicly traded companies, it's any company that has a specific threshold of $500 million as of revenues. So this is so we see the difficulty here, in kind of complying just in the data, and then even more on what to do. So what do you do about your scope 3?
Yeah, and I just want to touch a little bit on what you said about the differences between the SEC and the recent California bills, because that is a really interesting topic around doing business in California. The wording around that still needs to get sorted out by the California Air Resources Board. But the idea of the climate disclosure piece is any company doing business in California that makes over $1 billion needs to disclose. And then beyond that, the risk reporting is going to be, I think, 500 million doing business in California. So what does that look like? What does that mean for the supply chain? I think that's a super important question. Now, to get to your other question on scope 3. So scope 3 for us, we are really leaning heavily into clean fuels. So, we historically have delivered natural gas for the last 150 years to our customers. And we've been moving to renewable natural gas, which is a drop-in fuel, something we're increasing procurement of that over the coming years. Legislation has helped us do that with SB 1440 to require procurement of RNG for our customers. That's going to really help in decarbonizing our customer end use. In addition to that, hydrogen is something that the country and the world, and certainly California, is really leaning into to be a climate solution as well. And so particularly for the hard to abate sectors, I think it was spoken earlier by one of the speakers around the context setting in California is we're made up of a very high manufacturing employment in California. We have a lot of industrial processes in California that are hard to abate. So what are going to be the solutions that are going to work for those sectors that cannot decarbonize? What are the solutions for heavy duty trucking, for example, that can't move fully to electrification? So we think clean fuels like RNG and hydrogen really are going to be key. We have a proposal out there for a dedicated hydrogen pipeline in the LA basin, which is going to be that hard to decarbonize sector that we're really excited about, and we think will really help move California forward to get into net zero. In addition to that, carbon capture, carbon management is absolutely something that we're looking at, and that I think California is looking at as well. And I think even to tie back to some of the earlier discussion around, wildfires and, what climate change is actually doing, we think that there's a real opportunity there for the fuel cell and backup generation in those particular high wildfire sectors or sections of California to kind of help provide those types of solutions where it makes sense. So those are the types of things that we're leaning into.
Interesting. So we'll talk about net zero and carbon offset a little bit more about this. But just to go back also, like describing, one of these regulations, describing the risks to your company. What are the risks facing? So Beverly, you are, kind of advising companies on how to do that. So how many protocols are out there? What do you tell them to do basically?
Oh my gosh, there's a lot, right? Depending on which jurisdiction you reside. Sometimes you're a US company, but you have operations in Europe. So you have to also track regulations in Europe and in Asia as well. So what we tell companies is it's really a cross-functional team. It's not going to be one person. It's not just going to be Sarah as a chief sustainability officer. It has to be a cross-divisional effort. And we actually see trends right now of finance being involved even without knowledge of ESG. They're getting there, right? Your facilities, they need to be involved, your procurement. It's really an effort across the company. And also what's important is governance, like management, how ESG and sustainability has elevated in the priority list of management. It's become an imperative for business to do well in business. And also board agenda, right? It's top priority for the board to determine what's our company doing. So a couple of things there, right? Making sure governance is there, making sure you have the talent, and you're monitoring the developments that are happening across the globe where your operations are.
Yeah, so the questions of who is in charge and question of who is doing the work. So you guys have teams, maybe we can describe the teams, but this new reporting, are going to also require new people, right? So would you, any of you, I think Sarah or Eric, talk about how many people do you have working with you on these things, and what are the needs, in terms of?
Yeah, I'm
increase?
very lucky. So I have myself the largest, I think, sustainability team in real estate in America. I'm almost positive. So there's 10 of us. And then globally, there's well over 100. And then a dozen or more who are just dedicated sort of on the management side. So they're not dedicated to a particular region. We're in Asia and Australia and Europe. And yet we are like, yeah, we don't have what we need. We don't have the tool to measure it. I mean, basically, if you look at every Lend-Lease project, every, project company that holds a military community, we can't just ask every single project, be like, tell me all your concrete, all your glass, and all your aluminum siding. It never works. We actually have to be able to get that data from the top down. We have to go to Nucor, the steel manufacturer, and say, okay, you tell us everything that we bought from you, and that carbon data. They're not set up to do that. And we're actually not even set up to ask, right? So there's a whole level of extra people, which again, I have pain about, because I want those people to be doing the climate action and not the reporting. I will say, the transparency is important. So we're not going to be able to buy concrete or steel or any other major product from a company that doesn't do the disclosure. So it's already influencing our supply chain. And we've had to say no to a lot of suppliers. I just went through this for a concrete buy in LA, where we had 6 potential suppliers, only 2 could give us the data. And so we only had 2 suppliers we were choosing between, because we just can't work with you. We have requirements with our investors and whatnot. So I would just say the world is not set up to measure or disclose on scope 3. And let me just tell you, sustainability data is really hard. It's really hard. I had to cancel a call with my CEO this morning because we're like, I don't think the data accuracy is where it needs to be. And that was scope 1 and 2 for the most part. It's really difficult. And scope 3 is just going to blow it all up, especially because there are parts of scope 3 that you're like, is it in my scope 3? Like, we're going through this with employee travel, where we're like, flights, definitely I can be told when to fly and not. Employee automobile commuting, I can influence that over having benefits, or, where my office is set. Do I have, commuter benefits or EV charging stations or whatever, but I can't tell people where to live or where to drive. So is that in my scope 3 or not? We say that it's in this sort of middle category, but people just working through that is going to be a whole thing.
Yeah. So, I understand this kind of criticism, or, kind of collecting this data for what? If we don't have control over it, why should we gather it, right? Scope 3 is really kind of, others outside of the direct control of the company. So what can you do about this? So Eric, of course, here, we are in academia, we love data. So we're like, great, regulations are coming in. We'll have a lot of data to look at. We'll see what companies are doing. But the question is, is it the right type of regulation? Is it actually going to make a difference? Or is it something that's, we're going to get a big bureaucracy, tons of people, little people, analysts who are going to collect the data everywhere. And then what? What do you think, Eric?
I would like to think that the regulation is going to make a difference. Certainly, Honda spent the majority of its time thinking about actions toward change that are meaningful. And the regulation piece and the reporting piece is an important component, but it's maybe until recently been a little bit less in the front burner, if you will. But I think SB 253 is a change. I have a small team. And I was describing before that we're a regional headquarters for a global company. Our global company is responsible for our global reporting. But I think what's going to happen is there's going to need to be a skill, pardon me, and a process change inside our regional group to account for what is now a very local regulation, which I am sure will take a lot of time and depth of understanding to interpret and then act against. That's the kind of the change I see that's going to happen with what's happening right now in California for us. So we're probably going to need to look for experts that we don't have today to build skills or reskill people that are doing jobs that are now different jobs. That's the implication I'm anticipating.
So a lot of complexity. We have regulation from Europe. We have regulation maybe from the federal government. We have like local, California regulation. New York actually is going to also probably issue a similar regulation as California. So all these different processes. So Beverly, kind of, where do you find analysts to do this, and what are the complexity that people are kind of dealing with?
I would say EY. I'm just kidding. I would piggyback what Eric said. A lot of the core skills we already have in the workforce today. It needs to be tweaked for additional things, like an understanding of what GHG emission is, understanding of the different frameworks that are out there. My background is accounting, finance, process controls. Those are transferable to the skills that are needed under the new environment. When there's reporting on ESG, I look at the same thing. What are the process to get there? What are the controls to make sure that the reporting is in place? So I would say not to be scared for the people out here that this is a new thing. We all could learn new things. For us with EY, we do train a lot of our people. We do have admits that are experienced in the area already, and we enhance that further. We leverage their experience to train our employees. And so I think that's the good part in a consulting firm, where you have the resources and the bandwidth to upskill people. I think the challenge would be for companies, even maybe the smaller ones, right? Where to get the talent, how to continue to keep up to date with the regulations. So I would say balancing it out with maybe hire consultants for things that are routine, and then you can channel the resources into more transformational, delivering on your goals instead of the reporting part, what Sarah was mentioning earlier.
I would love to piggyback quickly off of what she said too, because I think this also presents an opportunity to even think about, as there was no, degrees for sustainability back in the day. Back when I was in school, there was no, a focus in that area. And now you're seeing that more and more. I think there is an opportunity in the education sector even to even consider, courses on carbon accounting, or, finding ways to kind of upskill before you even enter the workforce, I think will be a really great kind of opening and opportunity.
Yeah, I think that's a great opportunity for us at UCLA for sure, in terms of training students. We already have in the MBA program, an ESG class. Actually, Brad Sparks is teaching that class, and very successful, but we'll need to be even kind of deeper on the climate. But at this point, these regulations don't really tell us exactly what they're going to do. So they still need to be developed, and I'm sure they're getting some input from you guys on how this could be done. Is going to be, kind of important. So we have this, lots of work for you, lots of people you need to hire, and we will, kind of, what are the skills you think are needed on these people? So like, is it the sustainability thing? Is it what exactly they think they should be, they should be working on? What are the most important skills that you see in the kind of the new generation to help with these types of issues? Sarah or Eric?
Please.
Yeah, I found I've had the pleasure of hiring many people over the course of my career. And in real estate, what I've found is, for the most part, if you know sustainability, I can teach you real estate. If you know real estate, I can teach you sustainability. I cannot teach you passion. And that is what I need folks to be demonstrating, because we do hard jobs, and there's a lot of setbacks, and there's a lot of failure, and you have to love it enough to want to go forward. And so what I need is enough opportunities to show that you have that sort of demonstrated passion, so when things go badly, you're not going to give up. And so, what are the volunteer opportunities? I'll also just say the best class I took in business school was accounting by far. And everybody's like, oh, I don't want to take accounting. But when you're doing big renewables deals, you have to know how that's going to hit the books, or your tax people and your accounting people are not going to be able to work with you. So those sort of basic business skills are very good, but it depends on what you're doing. I would never hire somebody to do sustainability construction without a decade of construction experience. Construction is one of those industries where like there is no trust for outsiders. Just forget it. For military communities, I don't need you to have experience in military communities. Like Department of Defense is like, great, coming in, we can learn that. So it very much, there's not one blanket thing. It really depends on the part of it that you're working on. In terms of the reporting piece, any sort of basic reporting background or data analysis background is going to work for me.
Eric?
Yeah, interesting question. Honestly, I come at sustainability kind of from an engineering background and through a business lens. And I often find going back to some of the engineering principles have been taught or employed when I was an early associate in Honda are still really helpful to think about sustainability. So when I'm thinking about someone that I think would thrive, it's broad-based. maybe a little bit of science background, maybe some environmental science, I think would be important. Accounting certainly wouldn't hurt in this discipline. I tend to agree. Passion's really important in this space as well. But to me, underpinning it, somehow data and data analytics seem like a really important foundational piece. And all that we're going to talk about, especially in this, I mean, we're kind of focusing in on reporting today, which is going to be a lot about collecting, analyzing, validating, assuring data. And it's tough to even keep up with what data is now, let alone what it's going to be. So AI maybe becomes something in that space as well. But to me, that's got to be an essential part of a sustainability practitioner in the future.
So accounting, data, and passion. But passion, I guess, you know, for everything, we all need passion, right? So accounting, data, and then sustainability in terms of, I mean, today we're a lot, you know, hearing about, you know, kind of this kind of drastic planetary changes, Earth system, and understanding this. How can you predict what's going to happen for your company and write a risk assessment without a little understanding of some of the, you know, kind of the natural sciences? It's, I think, also some important elements. So I just wanted to open up for questions. We have a few minutes. And Ivan, yes.
Hi there. I'm curious as to how your respective companies and maybe for you on the client side, do you think about budgets for your areas, right? Other areas may have more science, like percent of sales or whatever that might be. So question part one is, how do you think about budgets? What's the mental model for your companies? And given that this is a forecast statement, what was it 2 years ago compared to what it is today? And if you had to forecast an increase, you know, 2 years out, what do you think it would look like?
We want to start.
I'll go first there, if
Okay.
that's okay. So fantastic question. We're thinking about it in two different ways right now. We have some earmarks that we've put aside aimed at taking on projects, thematic work that's going to make a tangible change to some part of the company, eliminate CO2, something like that. Secondarily, we're also looking at carbon pricing internally now. To be honest, that's a tough debate with a global company thinking about how to regionalize that. Do we have a global model or a regional model? I'm anticipating if we look ahead 2 years, we'll have a better sense of our carbon pricing scheme, and we'll be able to put that into play more, and we won't need an earmark like we have now to kind of prime the pump. That's what I'm expecting inside out.
And it totally depends on business unit. So, you know, you pick your partners carefully. So in our investment management development business, those are JVs with foreign pension funds, each of which require that the assets that we deliver to them are net neutrally operating from day one, including tenant emissions and the operational emissions from construction. We have the budget we need to get there, and very high rankings on something called the Global Real Estate Sustainability Benchmark, where the results just came out, or not for public consumption, but we all got our results on Monday. Wait for the stuff to come out on the 17th. So those are fine. A construction business at best is operating at a 3% margin. Boy, it is hard for them to get what it is that we need. And we have to be really, really creative in construction to get all electric construction equipment, to get renewable diesel, to get, I mean, there's a lot of horse trading there. Military housing is somewhere in the middle. The Department of Defense has a deep commitment to energy efficiency. They're a great partner, but it depends. So for example, with the solar there, we have to give them all the renewable energy certificates and they sell them. That's how the deals got financed. But they will also approve a 17-year payback solar deal because those are 50-year ground leases, right? So that totally makes sense to them, right? If the numbers work, the numbers work. So it really depends on who you're partnered with, what that budget is.
I'd love to touch a little bit about a couple angles here. So first, you know, capital allocation decisions at each company is shifting quite a bit. You know, we see more and more financial investments into California. People want to know that their investments are going towards climate solutions. And so, you know, even in the last year, we issued our first green bond to make sure that we're demonstrating that our investments are actually going towards emissions reductions, towards, you know, getting EVs up and running at our facilities, to green buildings, all of those things. And so I do think the financial community in general and investment community is starting to see that they want to know where their dollars are going. budget wise, because we are an essential service to customers, top of mind for us is affordability, right? So it's not just about, investment. It's also about, thinking about how that affordability aspect, especially for customers and communities of concern, low income customers. So you're thinking, short-term and long-term about, the transition's going to cost dollars. How are we going to do it in a strategic way that actually makes sense and will be successful for our stakeholders and our customers. So we have all of those kind of things top in mind today.
Yeah, and Beverly, this is a business for you. Like sustainability is a source of revenue, right?
It is, but same with the other companies that we have here. Mercury Insurance looks at it, focused on climate too. It impacts the product, it impacts the business. So I would talk about, I guess, respond to your question, and that it varies by company. The budget, the capital investment goes to, depending on the cost benefit that's been made by the company, whether it's going to benefit the business, the product. I think that gets more attention. It gets the budget. But I would say there is a weighing in on what's good to have and must have, especially in this environment where, like, regulations, if they're not final yet, companies are holding back on, like, do we really need to assess our gap versus a rule that's not yet final? So they're being more careful and thoughtful on what do they really absolutely need to do now versus can they defer it later. So I would say, like, there are things that are more priority. If it impacts the business, it's critical. It's a strategy. They made commitments. It's a reputational risk if they don't deliver. That gets priority. That gets in the budget, right? But there are things that the companies can weigh on. Is it really necessary now, or can we wait till the economy's better? That gets pushed back a little bit.
And on the forecast, as you asked, so do you think that you can reach some of these net zero goals without offsets, or what's your policy on that? Because I mean, this is really kind of a big question on what's the percentage of things that you can reduce, and how do you achieve this net zero, without offsets? Is it possible?
Not currently. Oh, things that are good. So absolute zero means no offsets. Obviously, like, we don't know what a zero carbon flight or a ton of concrete is either. But no, when we will hit net zero operating in 2025, there will be a use of offsets while we figure out how to decarbonize, the rest of our emissions, and renewable energy certificates for the energy. That's going to be part of the strategy, with the goal of not having that. That's why we set an absolute zero target. The goal being, like, let's start catalyzing that market transformation. Okay, so I can't get all electric construction equipment right now. You can get it in Oslo, can't get it here. It's one of those, the future is here. It's not evenly distributed. How do I work with the people who rent us construction equipment to send that pricing signal so that we can actually start manufacturing that, and then I can get it by 2040? You have to sort of take the very long view, but in the short term, offsets are going to be part of it. We're also interested in insets. So offsets generated by our own supply chains. We like those because we understand them better. I understand what it is to decarbonize concrete. There's very few of those available. There's only 2 concrete companies that are making offsets, and they're like at a 20x. But that's also what we'd like to see is, if you have to do offsetting, you do it within your own supply chain to sort of accelerate that decarbonization.
Similar approach for us. It's a time-based thing. When we look at the long arc of our big picture goals, no, we're not looking to have any offsets. But in the near term, when we're starting to disseminate the global goals into the regional spots around our global footprint, there are opportunities for us to think about near-term, mid-term targets where offsets are part of kind of that step approach to the final goal further away. So, and
just to kind of explain for those of you who are not familiar with the term offset, we forgot to define it. It's really kind of relying on a third party that will, conduct some operations such as reforestation, for example, to kind of offset some of the pollution by kind of companies.
Yeah, and there's removal offsets and avoidance offsets. And so right now we're not differentiating, but we want to get to 50-50 avoidance and removal offsets. So like and then they have to be at very specific standards. So it gets more and more complicated. The offset rabbit hole, I think we've all gone down. It's not an easy one.
Yeah, and I absolutely agree with everything you said, but I think carbon sequestration, that is definitely going to be part of the solution here. So, being get utility, we think obviously electrification, but clean electrification is going to be a big part of the future for renewables. clean molecules. Hydrogen, we foresee potentially having a hydrogen blend with RNG to help decarbonize. And then, for those sectors that just cannot do so, I think carbon management, carbon solutions to capture that carbon and store it, I think is going to be another way to get us there.
Get there.
Yeah.
Very broad perspective.
I've seen carbon offsets mostly now, but companies are also thinking about the future on how to reduce reliance on offsets. So power purchase agreement, renegotiating their energy supply. One thing, sorry, I just want to go back to the question earlier. When we talk about ESG and sustainability, we think about the cost and the expenses to get there. But I also want to emphasize that it creates opportunities for companies as well. Cars that are,
Consulting, for
yes, electrified cars, banks offering, not just for consulting, but like the banks that are financing this energy infrastructure that are being incentivized now by the government, that creates capital and activity in the market. So yeah.
Okay, well, I think we are out of time. I just want to thank you very much. Thank the panel for this really interesting discussion. So the next one.
Thank you, Magali and panelists. That was informative. We appreciate you being here and sharing your expertise. And just quickly before we adjourn, thank all of you for your patience with our technology glitches. And I'd like to also thank our sponsors, our principal sponsors, RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors is law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, Pacific Western Bank, Robert Half, United Airlines, and Venture Forward by GoDaddy. At the silver level, Bank of California, Comerica Wealth Management, Scott Work North America, and US Bank Private Wealth Management. At the bronze level, Hanmi Bank and HDR. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management and SoCal Gas. Again, we are a public institution. We could not put on these programs without the support of our sponsors, and we're most appreciative. This brings to a conclusion our September 2023 UCLA Anderson Forecast Conference. We are in San Francisco in November, and we'll be back here in the first week of December with an update, and you can see how well we did in forecasting. So drive safely. Thank you all for coming.